Farm Bill year, it's an opportunity for us to broaden our scope on the conversations that we're having. So hopefully you're going to get a chance to tap into that all day today, either through our speakers in front of the room or the sidebar conversations at your table or over lunch. Again, we want to thank our folks at Rank Agribusiness Institute for helping to coordinate this event. Like I said, it's very unique, not just to Wisconsin, but that are going to be sharing with you. In the morning, as you might recall, if you've been here before, we'll take a look at some of the staple ingredients of Wisconsin agriculture and the trends that some of our bright minds are looking forward to in 2024 or cringing for in 2024. And then in the afternoon, we're really going to pivot and focus in on rural livability. I think probably each one of us, like sustainability, may have a slightly different definition of what rural livability is. But we've got some really fantastic folks that are going to be joining us in person to share with you some of the data, some of the demographics, some of the trends that they're seeing when it comes to rural livability and the people that are populating what we call production agriculture. So really looking forward to that. Like I said, emphasis on being with us. If you've been part of this, you know that every once in a while we swing a little heavy on virtual. They're going to be here and get your questions ready. That's a little bit of the reason why I'm here, is to help facilitate your questions to the panel. So please, if you're kind of going along, jot down some notes, make sure if there's something that you don't understand, some knowledge you're not familiar with, a little deeper dive on something that they spoke about, please note that, and we'll have time at the end of the presentation when the panel is concluded to field those questions. And of course, like I said, because they're here, you can approach them a little bit later on. So I want to welcome to the podium the first fellow that is used to being the kickoff speaker for the 2024 UW Ag Outlook Forum. Where did he go? Steve Deller is there he is, economic development strategies at both the state and local level. And he keeps his ear to the ground as far as what's happening in rural Wisconsin, tying it all together again, like you said, with policy development. Please welcome to the podium as our kickoff speaker, Steve Deller.
I take it you're taking responsibility for this weather. Okay. All right. Good morning. I want to talk a little bit. I want to start off the conference by essentially talking about what's the economy look like going into the coming year. And I'd like to report that it's looking positive. It's looking good. It's looking as though that kind of economic soft landing that the Federal Reserve Bank is trying to achieve, I think they're going to hit it, okay? But what I want to do is kind of give you an overview of some of the things that's happening. This is a simple indicator of what's happening to gross domestic product at the state level, Wisconsin, which is the red line, the United States and the Great Lakes. And you can see the impact of COVID. You can see that Wisconsin recovered fairly quickly, but has been kind of flat. But you can also see the upticks in the most recent data. So, from a larger perspective, the U.S. economy has actually recovered quite nicely. Wisconsin's lagging behind just a little bit, and we'll get into why I think that might be. Okay, if we look at employment, you can again see that the U.S. employment rate is growing a little bit faster than Wisconsin and the Great Lakes, but we're right on par with what a lot of our neighboring states are doing. So is it that Wisconsin is kind of lagging behind, or is this more of a Midwest Great Lakes type phenomenon? I think we have to consider what's happening to the neighbors around us. If you look at the unemployment rate, however, Wisconsin's unemployment rate is pretty low. Wisconsin's unemployment rate has historically been one of the lowest unemployment rates around the Midwest. Wisconsinites like to work. Our labor force participation rate is one of the highest in the country. We like to work. But if you look at that unemployment rate, that kind of points to kind of the labor force issue that we're having now. As I work with rural communities across Wisconsin, there's a number of issues that almost every community is struggling with, and availability of labor is one of them. And that is also something that the agricultural industry is facing very heavily. And I think one of the things that we can look at is kind of the demand for labor and the supply of labor. What this is we're looking at the number of job openings, which is the kind of the darker line, and the number of unemployed. So the job openings is kind of the demand for labor, and the unemployed is kind of the supply of labor that's available. And you'll notice that up until about 2015, the number of unemployed people were greater than the number of job openings. There was a bit of a surplus of labor. But after that time period, that flipped. We had more job openings than we had people available in the labor force to take those jobs. There was a labor shortage. And then COVID hit. And then we recovered. Now, what's unique about what's the recovery is that we're seeing a lot more job openings now than we are people that are looking for work. That's the labor shortage. Now, the thing is, a lot of people think that this might be because of the effects of COVID. This is something that we were facing before COVID. COVID has just kind of put a spotlight on it because people are kind of rethinking work and nature of work, remote work, hybrid work, things like that. So this is not a unique phenomenon. Now, the most recent data, and I don't have this for the state of Wisconsin, Wisconsin hasn't posted it yet, but there's been 1 month for the US, and it looks as though this is starting to slow down a little bit. The number of job openings is declining just a little bit. It's not gone negative, but it's not quite as rapid. And the number of unemployed is ticked up ever so slightly. So that gap is getting a little bit smaller, okay? Now, what about economic forecasts? This is something that all economists like to pretend that we're economic forecasters. I mean, that's kind of the thing that we all kind of think that, yes, we do economic forecasting ourselves. I kind of rely on people that spend a lot of time doing this. Now, if all of you were economists and all you did was economic forecasting, right? Go with me. Maybe you need some more coffee while you think this through. But if I were to grab any one of you at random and ask you what your economic forecast was, you'd probably be wrong. But what the research suggests is that if I took an average of all of you, that average is probably going to be pretty accurate. All right? So one of the things that the Wall Street Journal does is they do a quarterly survey of about 70 different economic forecasters. And they make this available. And what I want to do is I want to use that information to kind of look at what the current thinking is in terms of economic forecasts. Okay? They do it quarterly. The most recent one was put out on January 14th. Sunday morning at 5 o'clock in the morning. I don't know why they would do Sunday morning at 5 o'clock in the morning, but that's when they posted it. So guess what I was doing that Sunday morning? This is a listing of all the various it goes from academics to banks to insurance companies. There's a lot of folks that spend a lot of time on this. Now, what I did is I essentially took an average, and then I computed the standard deviation, and I added a standard deviation, and I subtracted the standard deviation to kind of give you an idea of the range. This is the economic forecast for GDP over the next coming year. You can see the center dot there, that's the average. The height of the bar, the bottom of the bar is kind of that range. The tighter that is, the greater the confidence is that we have, the greater the degree of agreement there is. The farther that bar, there's more disagreement. What I like here is that other than that second quarter 2024, there's some economists that think we're going to go into a mild dip down, negative growth. But the overall average is that we're going to go into a slowdown, but a soft landing. We're not going to go into an economic recession. That magical soft landing, it looks like we might be hitting it. Okay? Now, this is a radical change because all of these forecasts over the past year, they've all been forecast, we're going to hit a recession. We're going to hit a recession. The question was, how deep of a recession? Is it going to be a mild recession? Is it going to be a deep recession? Folks have changed their minds. We're going to hit a soft landing now. Okay? Now, if we look at this forecast longer out, gross domestic product, we go out to 2026, you can see the 2024, the forecast is we're going to see a little bit of a dip down. We're not going to go into a recession. We're going to dip down, and then we're going to bounce right back up to about a 2% annual growth rate, which is about average for the US. That's what we would expect. Okay, now what about the unemployment rate? The unemployment rate is going to tick up. But from a historical perspective, these are very low unemployment rates. If you look at Wisconsin's average unemployment rate going back to 1976, it's about 5.3%. We're not going to be anywhere near that. Okay, so we're going to see a tick up in unemployment, but it's going to be a modest tick up. And then it's going to come right back down again. Okay? The unemployment rate going farther out in the future, same thing. We're going to be at around 4%, which is a pretty reasonable unemployment rate. Okay? Essentially, that tight labor market is going to start to loosen up a little bit. Now, what about consumer price index? This is what triggered the Fed to start raising interest rates, to get inflation under control. Okay, and the one measure that we tend to use a lot is consumer price index. That's the one that's oftentimes, you hear about like Social Security benefits, there's a cost of living adjustment, they use the consumer price index. When they adjust federal income tax, those income categories for taxes, they adjust them a little bit every year, they use the consumer price index for that, okay? Now, what the forecast is are we going to hit 2%? That's the magic goal of the Fed. Probably not, but we're going to get really, really close to it. Okay, so the idea here is the forecast is we're going to go down. Now, the Fed actually prefers a different consumer price index. They prefer the personal consumption expenditure price index. Okay, now this is where economists can kind of, you know, what's the right word? We debate about which is the best measure. Okay, well, the Fed thinks this is a better measure. They're the ones calling the shots, so let's look at this one. Same thing. Okay, the inflation rate is going to be coming down, all right, across the board. And we can talk about this later if you want to know the differences between these things. Okay, now what about interest rates? Notice that this is really clear. The interest rates, this is the 10-year Treasury notes. The forecasted interest rate is going to be about 3.7% going out. Notice that as you go farther out in time, that those bands get bigger. That's because as you go farther out into time, there's more noise, there's more uncertainty, more things can happen, like the Middle East. Or God forbid something happens with Taiwan. Okay, things happen that we cannot forecast. This is the midpoint of the federal funds rate. This is the key interest rate the Federal Reserve Bank is adjusting. What we're trying to do here is, we're not me, these economists are trying to do is forecast federal policy, okay? Now, what this is that banks, by law, have to have a certain amount of cash on hand at the end of the day, okay? It's regulations that came out of the Great Depression, okay? At the end of the business day, some banks have more cash than they need. Other banks are coming up short. Well, what they do is they lend money back and forth to each other. The interest rate that's set is this interest rate. This is set by policy. Okay? The idea here is that we're going to start to see that interest rate start to come down and probably level out at around 3%, which is kind of a historical average. Now, one of the things that the Wall Street Journal did is they asked, when do you think the Federal Reserve is going to stop dropping interest rates? They're thinking pretty soon. Okay? There's some argument. Any of you watch the stock market? The stock market yesterday set new highs. There's an argument that the stock market is essentially saying the Fed is going to start dropping interest rates, and they're going to start dropping them soon. These economists are essentially saying that probably by early summer, they're going to start dropping interest rates. I think that's a bit optimistic, okay? But this forecast is there's going to be relief coming shortly, is helping to build up the stock market. Okay, now, one of the questions is, what's the probability of a recession within the next 12 months? And the average here, you can see there's one person that said it's about a 2%. There's a couple people up there that say it's about an 80% average, okay? Have you heard the phrase, you put 10 economists in the room, you ask them a question, you get 12 different answers? There you go, okay? The average is 39%, the median is about 40%. So there is a probability that we might go into a recession. It's less than 50%. The reason we might go into a recession is stuff happens. Okay, look what's happening in the Middle East right now. Okay, there could be shocks that could derail the economy. Okay, and I will stop there, and I think I'm within time. But the economy looks like we're going to a soft landing. It looks like, if you look at the glass looks like it's half full. Okay? That doesn't mean that stuff can't derail the economy, but it looks like we're going in the right direction. Thank you. Are we doing questions? Are we doing questions?
That's it. Well, like I said, with due respect to the time that we are watching, you will have an opportunity to fire questions at Steve and Paul in just a little bit. And so this is a man responsible largely for what you're enjoying today. He is the chair of the Rank Agribusiness Institute, and he's also the theme behind today's Rural Livability. Paul Mitchell is, of course, the not only host for today, but he is also the Associate Dean for Academic Affairs, Cal's UW-Madison. He's a Department of Ag and Applied Economics and professor and director of the Rank Agribusiness Institute. He is most of his research program focus on the economics of crop production, emphasizing pest management, risk management for commodity crops, and specialty crop advisement as well. He's got a passel full of information guiding us into 2024 in risk management. Without further ado, please a warm welcome for your host, the brains behind this forum, Dr. Paul Mitchell.
All right. Thanks, Pam. And don't forget UW Extension as well. We're Division of Extension. Got a lot of hats to wear. Do I just hit the button here? Yeah. Okay. We'll start off with we're going to talk about sort of what's going on with farm income. This is what the USDA put out at the end of November 30th, so less than 2 months ago. This is their projection of U.S. net farm income, and it has the current years in there, 2023. And what you see here is net farm income, it's down 20% from what we had in 2022, but 2022 is a record year. We are still 31% above our long-run average. So yes, it's a drop from last year, but we're still doing quite well relative to our long-term economic returns. What's the drop in net farm income from? It's primarily due to declining prices. We'll get to that in a minute, but cash receipts. This is cash coming into farmers. This is the USDA's numbers from November 30th still. What's happening is I've got all the major commodities. On the left is crops, on the right is livestock. And what you see there is corn is down 10.5% in cash receipts to farmers. Soybeans down almost 6% in cash receipts to farmers. You can see the other ones there. Pretty much they're all down except for the, if I remember right, the fruits and nuts are up a tiny bit. And then go on the livestock side, they're all negative except for cattle and calves, beef, feeder cattle, and fed cattle. That one's up 16.5%. Poultry is down, but the big one is down. Dairy is down 18% in cash receipts. So we've seen these are rough years for most of our commodities relative to last year, but last year was a record high net farm income. So cash receipts are down across the board except for the cattle and calves. Here's an example of what we're talking about. This is a long-term look at crop prices here in Wisconsin. This is farm-level prices for corn and soybeans in Wisconsin, way back for the last 14 years. What you see is that big period in the middle where we had flat prices, and we have this big run-up at the end in 2020, 2021, 2022. It looks like we're coming down from that now. That's what I see here. We'll hear from John what's going on in the future a little bit. But what I'd like to show here is that, 440 is November. That's the last day we have these for, November. Down 28% over the last 12 months as of November. As for corn, soybeans down 10% in the last 12 months, so they're down. And what you see is how the shape of the corn one is very reminiscent. It looks a lot like what we saw back in 11, 12, 13. That same shape, and we're coming down. Where the new floor is, I don't know. We'll see. And soybean looks like it's a little bit longer. It has a longer tail of higher money, higher prices. We'll see. Here's dairy, the same thing. This is only for the last 5 years, but you can see as of November, it was $19.80 for dollars per hundredweight is the price here in Wisconsin, but it's down 16% over the last 12 months. But that peak back in the summer of 22 to that trough in the summer of 2023, that's a 43% decline in price of the price of milk here in the monthly price. So you can see prices are down, but farm income is down, but it was high in 2022. The big news for Wisconsin in 2023 was the drought. On the far right there is the monthly average rainfall. You can see we're really short in May and June, a couple inches each month. July hit back to average, and then August was dry, back to average in September. Temperatures were average. You look on the left there are those maps. This is the drought monitor maps. You got mid to late May, mid to late June, July, August, about the same time in each month. You can see June, Wisconsin's white. Nothing's problematic. By June 26th, the whole state has got abnormally dry or drought, and then it gets worse, especially in that southwestern corner there in mid-July. That's after 2 months of very short rainfall. Then in August, it kind of gets all splotchy and broken up. So that was the big news. Big parts of the state were looking at abnormally dry or different levels of drought. Particularly, you see those holes in June, or May and June, or yeah, I can't read it. Yeah, June and July, and then in August, we were short of rain. It had an impact on the crops. This is the USDA's estimate of crop conditions. This is the percent of corn acres in good to excellent condition. On the top row, the bottom row is soybean in good to excellent condition. The markets like to watch this to kind of get a sense of how the crops are doing. And what you see there is the left is Wisconsin, the right is the United States. Corn in Wisconsin started out average in April, but quickly fell, or May, quickly fell into way low, down to about half of the crop is all that was good to excellent. That means the other half of the crop is not in good shape, and it stayed down there for the whole season. Worse in the last 5 years than we've seen. You can see how much lower there is. That's half the corn was in rough shape. Half the soybeans is rough shape. So you can kind of see how the crops did not look good this year. Anyone that was out there, you could see it. The U.S., they were low as well, but not so starkly less. You can see how it's more like 2022, 2019. It wasn't there, that gap between in Wisconsin between 2023 and the other worse year is much larger. So we had relatively poor looking crops than they did at the U.S. level. Then on January 12th now, the USDA put out their newest newest yield numbers. And so what I'd like to show you is how here in Wisconsin we had 176 for corn, 2.2% down from last year, and soybeans, I can't even read the numbers, it's 51 if I remember right, yeah, 51, 5.6% down. This is after a couple good years, but what I really like to show here is how both these crops had very different experiences around the Midwest. Iowa, corn was up a little bit, it's blue, that means it was up from last year. Lighter blue, okay, it was up 0.5%, but soybeans in Iowa were down from last year. Wisconsin is all red, Minnesota's all red, but look at Missouri, not a big state for crop production, but corn was down, soybeans were up. Nebraska, Kansas, corn was up, soybeans were down. It depended on when the rain fell and where and what kind of soils you had. Very different experiences. The only states that are consistently red in the upper Midwest, Wisconsin and Minnesota, both were red in both. So both corn and soybeans were down. We sort of had the brunt of it. But then, so what happened at the U.S. when they announced these yields just a couple weeks ago? Not even. U.S. corn set a new record. 177.3 is the average yield for the U.S. U.S. soybeans were 50.6 bushels per acre, tied for fourth, so not bad. Wisconsin, 176. That's our third highest. We had record yields last year and the year before, so we actually didn't do that bad on corn. Soybeans were in 51, that's fifth. Our silage, we're tied for third. The big years were 2021 and 2022. And so 2023, after the record years, it came down a little bit. So the drought had a much less of an impact than you might think, nationally and in Wisconsin. This is the map on the right is where it was in September, basically early September, Labor Day weekend is where you can see all those red areas. So what were the drought impacts in Wisconsin? We see yield losses were spotty. It really depended on when you got that rain and where your crop was in its crop phenology, where it was in its growth process. And then also what your soils were, when and where the rain fell and what your soils were like. But we have seen these price declines I saw in the other figures, and most farmers in the state have revenue protection crop insurance. And so when the prices come down, that's part of your losses. And so they have the initial price in March and then the final harvest price. We saw corn have a 17% decline in revenue just from the price change. Soybeans is down 7%. Wheat was down 7%. So already farmers with that revenue protection policy have a 17% yield loss or a revenue loss or a 7% yield loss. So crop insurance is going to make some payments this year. Crop insurance is already paid as of Monday, paid $132 million in the state, big chunk of it for corn, soybeans, and then forage and wheat have a few $1 million. There's more to come. There's far from over yet, but these are the big ones after those price changes. The big ones coming yet are what these policies called ECO and SCO. They're based off of county yields, and so we got to wait for county yield data in March. But we're going to see that go up. And so what it really is, it's a very spotty. If you're in an area that didn't get enough rain, you very likely triggered crop insurance indemnities because your yields were even just a little bit below average with that decline in corn prices, you're going to trigger payments. The other big one is, like I said, the forage production was down. Hay stocks in the state are at a record low. We haven't seen them this low in 75 years. A lot of this is that we're not using as much hay, but it was also dry. If you look at that last year, there's a big drop here from 2022 to 2023. If we zoomed into that far right corner, hay prices hit a 3-year high, so that's part of the, supply's short, there's demand. So now let's look, wrong way. Now let's look at some farm finance stuff. This is in August, this is land values. This is all the states, this is cropland. Wisconsin land values for 2023 were up 11.8%. We're the highest around all of our neighbors. Michigan up at 11.3, but all of our neighboring states do not have this highest increase in land values, in cropland values. You have to go to the northern Great Plains to see anything higher than Wisconsin. So we're pretty high relative to the rest of the nation in increase in value. This is as of August. This is the historical data. Wisconsin's the red line. The U.S. is the blue line. You can see after several years of flat land values, the last 3 years have been jump up, jump up, jump up. We saw another big increase at 11.8%. Over the last 3 years, we've seen a 40% increase in land values. Even more than that, 40.6 according to USDA data. That's really helped a lot of farm balance sheets. If you've got your land, if you own land, you've watched your equity increase. So that's really been a big part of the farm economy here, has been these big jump and increase in land values. Wisconsin's following that national trend. But I think the land values are slowing. This is the Chicago Federal Reserve Bank does District 7. That's that little map in the upper right corner. It's about 2/3 of Wisconsin, Iowa, the northern parts of Illinois and Indiana, and then the lower peninsula of Michigan. This is their year-over-year increase of land values. And looking at that far right side, that last one is the third quarter of 2023. So 5% increase was the average increase. But you can see how it was over 25% almost for almost a year. We saw a big increase in land values, just like I showed in that graph for for Wisconsin. And then as we come down, we're on the tail end of this. It looks very much like land value increases are definitely slowing down. They have this data broken out by quarter. This is these maps, and this is always, they make the same style. Once you learn how to read it, it's useful, but you gotta get used to it. The top number in each little part, sub-district within the 7th district is how much it changed in the second quarter, and then the number at the bottom is the annual change year over year for the third quarter. So the bottom number is the annual change, the middle number, or the top number is how much in that district it changed. What you see is a lot of low numbers there. Wisconsin is at -1%, that's in second quarter, so flat. Iowa, western Iowa is negative out there. Southeastern Iowa, negative. Northwestern Illinois, negative, meaning that land values really slowed down on that good to good farmland. This is not all farmland, this is good farmland. So it's a lot of evidence that these increases in farmland values that we've seen for the last 3 years are likely slowing down. Higher land values means higher rents. This came out in August. This is the average rental rates for cropland in Wisconsin. The average for the whole state was 151, up over 4% from the year before. These counties in dark green are the ones that had the largest increase, over $20 an acre. It's all in the southwestern and the driftless region there, Grant and Lafayette, La Crosse and Trempealeau County, and then some other ones right next to them for the 15 to 20, then a smattering elsewhere. But you can see on the right is that table. Lafayette and Grant County lead the state in average rental rates, $259 and $241. Another one, but here Dane County, we're in $205. Then there's a big chunk of counties there in that upper 190s. These are all our major ag counties, but there's been a big increase in land rental rates associated with this increase in land values as well. So this is definitely creating a cost problem for farmers. Wrong way. Interest rates continue to increase. This is again from the Chicago Fed. This is for operating loans and for land real estate loans. You can see 8.5 and 7.7% for the two. This is in the third quarter, so October 1st of last year. But you can see they're starting to bend over, and you heard Steve Deller's talk. I think we're going to start seeing these coming down, but definitely high for the first time. We've been seeing some high interest rates. This is the total cost. Now, this is national USDA number, and this is expenditures on each of these items. If you look at the USDA data for agriculture, the cost to grow crops and to raise livestock across all of the different things we do in agriculture, it's pretty flat. It's up a tiny, tiny bit. It's barely even a 0.1%. So costs are holding steady, but that's at the aggregate in net. There's lots of variation within them. What's the big increase in cost? Interest spending costs for interest up 43% from 2022 to 2023. Livestock, 20%, that's for feeder livestock. If you've got to buy cattle to put on a feedlot, up 20%. You think back to how beef cattle prices last year were pretty, cattle and calves are expensive. Labor's up, we heard from Steve how tight the labor supply is. Seed, these are all national averages, expenditures are up in all those. And what are they down? Fertilizer's down a bunch. That's good news for crop farmers, especially corn. Fuel is down 11%. Feed is down a little bit because crop prices are down. In net, costs are about a break even, holding steady from last year. What's the 2020 forecast for crops, especially thin margins? These are crop budgets from UW Extension, the county educators, the Iowa State University, and Northern Illinois from the University of Illinois. These are all come out in January here. We got corn and soybeans for both of them, corn after corn or corn after soybeans for Iowa. And these are what they call the break-even prices. This is their best guess after cover. You got to pay for everything. You got to pay for the land, so you got to cover opportunity cost if you were to rent it out. You got to also pay for the farmer's time, the management effort. So this is, then you got all your variable inputs and machinery and everything. So Wisconsin, they're about $5 is the break-even price for corn. If you're going to be raising corn in Wisconsin, that means if you're getting less than that, you're not paying yourself a full wage. You're not paying for the cost of the land if you were to rent it out, or if you're renting it. Soybean is about $11.38. Iowa, they got corn after corn, a little more expensive, $5.11 to $5.25. Corn after soybeans, about $4.50. Soybeans themselves, in that $11.09 to $11.50. It depends on what your yields are, basically how much input you put on. Northern Illinois is expensive. $5.13 is a break-even price for corn. Soybean, $11.94. Overall, these break-even prices are down 5 to 7% relative to last year, but last year was the most expensive corn and soybean crops ever put in. So, and costs have been moderating. But what's the break-even, or what's the USDA's forecast for prices? Corn about $4.50, soybeans at about $11.30. You can see there that Wisconsin corn farmers, if we get those prices and these break-even prices, they're not going to be making a fair return on their corn. They're about breaking even on the soybeans, covering their own time and energy and their land. Iowa's corn after soybeans, and soybeans are about the only ones that are breaking even. Northern Illinois, they're projecting losses, where you're not paying yourself a fair wage. You're not covering your cost of covering all your input or your opportunity costs. So what's the farm income situation outlook? Our farm income is down about 20%, but we're still good relative to our long-run averages, over 30% above that 20-year average. What's the outlook? We're moving back towards the average, mostly due to declines in prices and that land value increase that's been driving a lot of a lot of excitement in agriculture, these big jumps. It looks like it's leveling off as we go into 2024. So things are slowing down on the land values, and we'll see how the farm economy does. All right.
I apologize for not reading all of your credentials. I think I need my cheaters for the afternoon. The print gets smaller and smaller, and his title gets longer and longer. Thanks again, Paul.
You're welcome.
So this is the portion of the program where it gives you an opportunity to ask questions from the floor. There's 2 microphones that are stationed in kind of the middle. If you've got a question that you'd like to share with the audience, please feel free. Before I forget, if you're like me and feel a need to be connected to the internet, if you jump online, you can find UW-Net available here in the ballroom. You create your own guest user access, and you're good to go. So just thought I'd share that because it made me crazy not to be able to find something. Sarah, how you doing, kid? What do you got for our guest today?
Hi, thank you very much. Sarah Lloyd, I work on the Grassland 2.0 project at the UW. Going back to the discussion of GDP, gross domestic product, I'm just wondering, there's a lot of alternative measures like happiness indexes and social development or sustainable development indices. And I'm wondering if you or someone at Wisconsin is layering in some of those other ways of measuring what the actual social and economic outputs are of these systems.
The afternoon session is exactly designed to address that question. One of the things that economists tend to focus on things we can measure: jobs, income, businesses, GDP. We can measure it with a fair amount of accuracy. When we start to get into things like quality of life and livability, it becomes squishy. But there's an initiative, the Rural Livability Project, that's being funded by a grant out of the College of Agriculture and Life Sciences, that is trying to actually put some meat on that. And Amanda Weinstein from the Rural Institute, thank you. is going to be talking about some approaches that we can do that. So great,
Glad I
great
set
setup,
that up, yeah.
great setup for the afternoon.
Anybody else have, I'm just going to ask big question, but maybe both can chime in. So I'm watching those trends. Noticed O'Connell County didn't make it anywhere near rent values. What about the demographic changes? How many of these landowners are retirement age and don't want to stick their neck out on another operating loan at what I know is going to be a loss? I've got some equity built up. I've got a little bit of savings. I'm curious what we're thinking. Are they going to flatline it? Not to take off Sarah, but are they going to plant it to grass, roll it to pasture, oats, something that's less risk? And if that's the case, and then the other one, Paul, is ARC PLC. You teased me with that before we started. So demographics, if you want, as far as none of us necessarily getting any younger, but still baby boomers holding the largest cash hold in the United States, go for it.
Yeah, that's the one thing. These are, I think the reality is back to like what Steve was saying, what Sarah's alluding to. If you've got your farm paid for or nearly paid for, you don't have to be as responsive to, oh, I got to cover my opportunity costs. I could have rented this out. Once you get to that later stages of life in your phase of your career, you can start looking at broader things. And you see that. Iowa State University did a big survey, and you see a lot more interest in conservation programs and stuff like that. It's in those, when you're trying to make a living and you've got young family you're supporting, you got kids you want to send to UW-Madison to go to college, you got to cover that tuition dollars so Steve and I can get our salaries. And stuff like that. It's expensive. And then as you move into later, and so it's kind of as part of that career, and we're seeing a lot of farmers moving into, and farmers always been, the land ownership has always been at the older level. And the hard part is, so they're more interested in other things than just making a straight, got to make money, got to cover those opportunity costs for land, got to cover those opportunity costs for my time and energy. You start looking at broader things like rural livability and conservation programs and such. But the other thing then is the difficulty is getting the next generation into farming. That's the hard part. If you're 30 years old and trying to get into this, you got high interest rates, you got high land values. Oh my gosh, how am I going to start as farming? That's where these farm transition programs are so important, is finding out ways, and that's who really bears the cost of these high interest rates, high land values, and high rental rates, is the younger generation trying to get in. And I think what you're seeing is some of these older generations are trying to find ways to get the next generation into farming. And they don't always have to get fair market values necessarily, particularly for relatives. But it is a definite burden, is trying to get in when those interest rates are high. We'll talk about ARC and PLC briefly, but I took a slide out on the Farm Bill. Basically, I don't know what's going to happen in the Farm Bill. Jeepers cats. Who knows if we're going to get a Farm Bill. Another extension. There does seem to be some stomach for raising the price floors and maybe having an escalator like it's actually kicking in. But this year, right now, these prices we're projecting, I think in ARC is the better policy to sign up for, the better program to sign up for your base acres for across all the crops. There's a new price forecast coming out from the USDA in mid-February. Maybe I'll update myself. But right now, if you got to make up your sign-up elections, I have it on my webpage, go with the county ARC program. You got some questions?
I think the one thing I'll add to that is one of the things, I'm from Illinois, where farming is corn and beans. Beans and corn, period, that's it. Wisconsin agriculture is extremely diversified in terms of the crops, in terms of the commodities, in terms of the products, also in terms of the size of the operations. We're seeing a growth in the number of small farms. So when we talk about these things, it's really kind of hard to make broad generalizations because Wisconsin farming is so diversified. So these guys have a real challenge because they're trying to give advice, and what may make sense for a big corn and soybean farmer may not make sense for a smaller scale operator. So my hat's off to them trying to,
Doug?
Yeah, this is a related question. I do a lot of work in the dairy industry, and the size of dairy farms tends to double. There's a doubling effect sort of with each generation or even less. So, now we're seeing farms with 3,000 cows doubling to 6,000 cows, so my question is the rate of change in the size of operation the consolidation of, both in dairy but also in the cropping fields, is that rate of change increasing?
Nationally, no. It's slowing down. Most of the consolidation occurred after the farm crisis in the early 1980s. So there's tremendous consolidation, tremendous growth, but this is a national perspective. It really started to slow down towards the end of the 1980s. So what we're seeing here is kind of happening at the tails of the distribution. So what we're seeing is growth in the very largest farms, a small increase in that end of the tail. We're seeing a bigger increase in smaller farms. But I think in terms of the ability to continue that, it's going to depend on where you're at in the state, because a lot of those farms require local approval. And we know that in some parts of Wisconsin, there's real pushback on those big CAFOs. Other parts of the state welcome with open arms. So it depends on where you're at in the state.
But we also have smaller farms that are multi-site dairies, just to stay under the numbers.
Part of the doubling too is I'm in my late 50s now, and if I had a son and I was a dairy farmer and we're ready to, he or she, maybe it's my daughter, we're ready to move into part of the operation, all of a sudden now I've got two families to support. How am I going to support two families? I got to get bigger. It's not just me anymore. So what do? If you want to have two incomes, you got to have double the cows. I mean, that's kind of the idea, and hopefully, so that's driving part of it as well. I haven't looked at the data this year. A lot of years I do the dairy farm consolidation. I look at farm bankruptcies. I didn't do that this year, but that rate's been pretty steady. But I would defer, maybe ask the same question to Chuck Nicholson when he does the dairy talk. If he's been I don't know if he's been looking at, but I know the average the average cows in the state is over 200 now as of not the summer of 2023, but the summer of 2022. And that's that's a large dairy now, or an average dairy is over 200 cattle. So that used to be considered a large dairy, and it's not anymore.
One more question.
You also have
Yep.
kind of two economic units on the farm. You have the farm enterprise itself. You also have the farm family. And increasingly, those farm families are dependent upon off-farm income.
Yeah.
So this labor shortage, there's a real opportunity here for a lot of these farms. The farm enterprise can't support two families, but off-farm income can keep the family afloat, which allows the farm to continue operating.
That's how I grew up.
I have a market question related to supply and demand. So I am a cash crop farmer, grain and canning vegetables. What I see is that the market for, particularly on the grain side, is pretty much influenced by the amount of exports that we can. And we are badly hurt because of geopolitical issues, particularly with China. And Mexico is unable to compensate for losses in exports to China. So in addition to that, what I see is we can no longer compete with Brazil and Argentina in terms of corn and soybeans. And on the candied vegetable side, we have a demand issue there that there just isn't enough demand, so then on the grain side, what do we replace our grains with? There just isn't the market for these small grains. So how are we who are trying to engage in this market of cash cropping able to survive in the future, and how do you look at that? Thank you.
I'll say a little bit, and then I think when John does his talk on grains, he can talk a little bit about it, John Heinberg. Yeah, that's a real problem. I mean, a few years ago, I think it's 2021 or 22, is when Brazil became the world's largest soybean producer. They surpassed the U.S. We are now number 2 in soybeans. And China is the world's number 2 corn producer. In terms of bushels, just raw number of bushels or metric tons, whatever you want to use. But their yields about a decade ago were half of what ours were. Now they're like 65%. They're gaining on us. And there's going to come, so I think basic reality is we've got a lot of extra grain production in the world, and the rest of the world's catching up to us. We're keeping ahead, but that gap is going to keep shrinking. And so I think the reality is, yeah, we're really good at corn and soybeans, but that's not going to last. The rest of the world's catching up, and that's just what's going to happen. That's like the long run trend. And then the canning crops are a good example. We're really good at doing canned vegetables, but the world doesn't want a lot of canned vegetables. And my understanding is we can't export them very well. It's the metal. The metal tariffs are really killing us. And my understanding is the vegetables aren't worth that much in the can, it's the can itself. And so we have a project to look at some of that, kind of come up with some different alternatives. But some of these multinational companies are looking to, instead of exporting exporting the metal and the vegetables in the can, let's put the processing facility somewhere else. Well, some companies can't do that, and it's a real struggle. What am I going to do? And that the struggle you were facing, Michael, about what do I do for crops, what do I do for canning vegetables, the companies are facing the same issues. They got to think about how do we maintain competitiveness in a global market for grain, but also for our what we're good at, canned processed vegetables. So there's no easy answers. Competition is tough. That's always the way it is. Competition is it's a two-edged sword in that sense. It cuts both ways, and so you got to be careful. If you're really good at it, you attract attention, and other people start getting really good at it too. So.
Very good questions. Good kickoff to this Ag Outlook Forum. Let's thank Steve and Paul again for sharing their insights and guidance. We'll take a couple-minute break to let you go re-water yourselves, bathroom break, return phone calls, emails, what have you, and then we will be back here to begin our next segment with John Heinberg from Total Farm Marketing promptly at 11 a.m. So enjoy your break. We'll be back in just a couple moments. ladies and gentlemen, time has flown. Time to sit back down and experience the next set of our speakers. And these are the folks that will probably get down to a few more details relative to some of the questions that we heard a little bit earlier this morning. Again, welcome to all of you. We appreciate you being here. Plenty of time yet in the day to have an opportunity to catch up with old friends as well as meet some new. Again, my name is Pam Yankee. We appreciate you being here. Next up is a friend of ours. We have John on the air with us every week to try to keep guidance for our grain producers, livestock producers, dairy producers, depending on what target in the globe we're looking at. John Heinberg is with Total Farm Marketing out of West Bend. He is a market advisor with more than a decade of experience in agricultural education. He believes that farm marketing success goes hand in hand with the right resources when you need them, and the confidence you get by working with somebody who can simplify everything in difficult marketing situations, which is exactly the teacher in him comes out very well on the radio when you start talking about complex situations, both on a geopolitical situation and just simple program situations. Please give a warm welcome to a fellow that came over from West Bend in this slop, John Heinberg, Total Farm Marketing out of West Bend.
All right, good morning. So I'll kind of spin off of what Paul was talking about in terms of some of the crop prices, things of that nature. Remember when I kind of do my presentations, my target audience a lot of times is producers, and the things I relate back to you too are what they're telling me and what we're seeing out there right now. Okay, it's obviously a very difficult situation given the way the markets have acted over the last basically 6-7 months here. So let's just kind of get right into things here very, very quickly. First off, excuse me, went too far. Corn prices, we've been on a bit of a slippery slope basically since we put those June highs in as we were really focused on the weather. And that really put a lot of farmers behind the 8 ball. We had weather, very, very difficult. Crop was very, very questionable in terms of what we had. So a lot of guys sat on their hands, did not sell grain because just didn't know what their production was going to be. As Paul mentioned too, last year's corn and soybean crop was one of the most expensive crops out there that we've ever planted because of the cost of inputs, due to inflation, due to just shortages, whatever came into play. And now we're starting to see that. Obviously now we've been on the slippery slope. Prices did pop a little bit higher today, but guess what? We are now reversing to the downside today. So it's making me a little nervous that we've got more room for this market to go. Soybeans have been a little bit more reflective of the tighter supply, but now as we're getting through the South American weather concerns, obviously, we can see what's happening in terms of price here. You look at basically, I think prices are reflecting the current market conditions. What worries me the most is the amount of air, as I call it, underneath these charts if we break these last key support levels. You can kind of see corn has already broken through that $5 barrier, $4.50 barrier. Now we're looking at targeting maybe the low 4s. We'll see if that can hold true or not. There's some things that have to come together here as we go forward. Soybeans, to me, that market has got a lot of air underneath of it if we kind of break through this key spot here, this $12 window. Again, making producers very, very nervous. We talk about what we call the market cycle of emotions in terms of how producers feel. Obviously, when we were in June, they loved the prices. Things were great. Okay, but that's when we had our maximum risk. Unfortunately, because of concerns regarding the crop, cost, whatever, a lot of guys didn't put the risk in, and now they're feeling it. Now we're in this fear, desperation, panic mode as we're like, hey, I'm not going to be able to pay my bills. I still got corn to sell. Prices don't look like they're coming out of things, so they're getting very, very anxious. To me, we have to hit, unfortunately, this capitulation, hopelessness where things throw up their hands. That's when I think we hit to our market bottoms. I don't think we're there yet, unfortunately, just given the whole scheme of things. So let's just quickly look at 2024 going forward. Supply picture, I'll touch on that. Where's the demand? I'm going to spend a little more time there. Some of the macro things that we're seeing in the economic side, obviously I'm not going to get into in depth as our economists will. Potential that South America crop, because that's been the buzz all winter, what's happening there, and then basically a little bit of 2024 weather. So first off, our growing supply picture, very, very unique year for producers. 177.3 bushels per acre is the USDA number that came out. Big change in terms of raising that yield up off the last report. Really kind of shocked the market. USDA made some demand adjustments, so we really didn't overflow the supply side, okay, but it did go up. But at the same time, you look where we were the last 2 years prior, We just got overabundance of corn. And that was the thing I heard from producers as we got to the second half of harvest. They were just amazed how well those crops yielded with the little rainfall that we had. Again, like Paul said, it came down to your soil type when the rain came. And right now, we've just got this pile of corn that we need to find a home for, and we don't have it at this time frame. Soybeans, obviously, is still a reflective supply, but again, another bump up in yield, a little bit demand concerns on soybeans. I'll touch that in a moment. But again, now we're got to carry out, pushing back to that 300 million bushel level, which is still relatively tight, but at the same time, the trend is not in the right direction. Stocks use is a measure of how much supply is available. Corn, we're about 14.6%, soybeans 6.7%, but you can see the upward trend in both of those as supplies continue to tighten or continue to grow. The biggest thing I look at, this is a very busy chart. That 14.6%, if you see the red line, that is the potential range of prices given that stocks use, which is that available supply. So we're looking at a range 450 down to 350 in terms of price window. Now we throw just cost of production, keeps things to the top end of that, but it wouldn't surprise me we see prices fall in that area given the supply picture. Obviously things can change very, very quickly given the events of the world. On the soybean side, $12 to $10 that stocks to use. Okay, it could be a potential landing zone as we get into prices for the rest of the year, but we really have to watch what next year's production gives us. On the global scale, if you look at soybean stocks, corn stocks, again, trending to the upside, probably going to be influenced by what we're going to see out of South America, as well as that jump in U.S. production. On the soybean side, obviously the South American production is a big factor, adding to the growth that we saw in our crops over the last handful of months. Cash markets, one thing we focus on. You can see the difference just reflecting the supply. This is corn basis on the green line last year, obviously trending above 5-year averages. This year we're towards the bottom of that range. Again, just reflecting the supply that we see. Soybeans, very, very similar. Last year we were above 5-year averages. This year we're down below, again, with some concerns. I'm going to get into the demand side of the equation now. That's where it really is the talk in this marketplace. First off, export front, export targets. Corn's actually off to a pretty good start, up 36% from last year. But unfortunately, if you look at that green line, last year was pretty awful. So the 5-year average is the purple. We're challenging that 5-year average. We continue to see demand. Fortunately, we're a little concerned where that's going in the longer term. Soybeans, not a good year going so far at this time frame. Again, 18% down from last year. Last year was a pretty good year. That was due to the tighter supplies out of South America or Brazil due to their crop, as well as Argentina. Brought that export demand here. They've got those supplies potentially coming. Changes the whole dynamic. We look at the China factor, and I want to spend a little time on this. In my interview this morning, I talked about this a little bit too in terms of the radio show. Let's go look at the corn side of the equation. That's where everybody is waiting for China to show up. Okay, typically, within the exceptions of the last couple of years, they do not buy a lot of U.S. corn. It came out of the Ukraine. Then the United States jumped in for basically about 3 straight years. Now they're getting it from Brazil. So that's the concern point, is that Chinese demand is not going to be here. We can see 1.758 million metric tons. You can see for the 2 previous years, 21, 22, okay, 2021, even 22, 23, how much more there was in terms of demand. On the soybean side, just again, overall competition globally, again, running well below previous year's levels in terms of that Chinese demand that comes into play. Tied to either geopolitical, tied to just markets in general. Okay, I do think there is some retaliation for some of the geopolitical things going on that's keeping China out of our market, but at the same time, they are still the shrewdest marketers in the world. They buy value. The value is not in the United States prices right now. Classic example, look at the corn side of the equation. This is Brazil's corn exports. Okay, monster jump after their strong crop this last season. Record levels of corn exports, 29% or 30% of that basically went to China. We've seen an explosion in movement the last 4 months, September, October, November, December. We've seen a high amount of corn move to China from Brazil. That's a window that we're counting on that business to be here. If you go look at just over the history of time frame, the impact of Brazil, 40% of Brazilian corn imports, okay, or corn from that China brought in came from Brazil, obviously replacing a major portion that they would buy from us. So that's the question if they do come into our marketplace. We'll see if that does occur. On the soybean side, again, the Brazilian current export numbers are extremely high compared to history. 73% of all the bushels that they ship out have gone to China in terms of soybean exports. If you go look at, again, this is a combination, soybean meal, and corn. In terms of Brazilian exports, you can see the explosion in the Brazilian shipments, okay? Again, strong production, lower prices, things of that nature have really come into play. And most of that, again, is that Chinese business. But again, December, those numbers coming in now, 8th consecutive monthly record of combined corn, soybean, and soybean meal exports to China. So that continues to be the big question. And the demand side, does that come around? Right now, it doesn't feel that way. We'll talk a little bit more about their production in just a moment. Other factors domestically, what's key? Ethanol has been fairly solid this year, okay? But we are concerned about fuel consumption. We've seen some of those rates come down recently. That directly relates to the ethanol side. Again, soybean oil is the big talk in the soybean industry. We are replacing a lot of our lost soybean demand with domestic demand, and that's very much tied to crude oil prices, diesel prices, and you can see we just had record crush numbers released for December, so there is some optimism that we could still see that demand stay there. Looking on the macro side of things, just going to put up a couple different trends that I've been kind of noticing. Obviously, first off, US dollar index and commodity index. Okay, everybody always talks about strong dollar, bad commodity prices, weak dollar, good commodity prices. Realistically, probably tied to inflation. I'll show that in just a moment. The recent run between the strength in the dollar and the tie to commodities have been pretty much hand in hand. Okay, again, I think that's more inflation tied. Now, as inflation's coming under control per se, now maybe we're starting to see that deviation where the stronger dollar could impact commodity prices again. One other side of it too, you can see the equity markets, they were working fairly well together, but now that divergence is coming as money reflecting maybe tight changes in policy. We're seeing it move more to the equity side, weighing on the commodity side. The commodity side's obviously been impacted by the anti-inflation play, as funds and managed money have moved away from their positions in the ags, and I'll show that in just a moment, reflecting again, hey, we want to be in the equity markets where the returns are, against those deflationary type plays in the commodity sector. So again, just showing that relationship. This is the inflation chart, basically consumer price index. You can see the spike we had after the COVID 2020 kind of washout. Again, notice the reflection in the Goldman Sachs commodity index. Now that is also very driven by energy prices in terms of the main focus there, but it's a very good pattern as we can see as inflation's come down. So as the commodity indexes as well. Again, that anti-inflation mentality in terms of the commodity prices. So that brings me to the funds and the flow of money. Probably one of the most hated conversations you have with producers is about money flow. Okay, right now probably the biggest weakness in our prices is basically how the money is pushing this market to the downside because they have no reason to get out of a short position at this time frame. So if you take a look at it, here's basically corn futures. Again, we're down about 260,000 short contracts. In other words, they take their longs, their shorts, their options, compile them together, get a net number, which is 260,000 negative. As you can see, it's almost down to the COVID lows actually below the COVID lows, looking to challenge some of the lowest levels in multiple years. Again, that is a direct reflection to our prices. Soybeans, we've seen the hard sell-off now as this Brazilian weather has seemed to have straightened out, and now they're pushing that to a negative position. And again, just watching the market prices here makes me fearful they got some room to push this even further. On the ag sector in general, this is a little bit more on the big picture side, but this is over the last 24 months. The black line is the net position of all agricultural contracts. As you can see, they have pushed this now. This was about a week ago. It's actually grown some since then. 490,000 contracts short across the entire ag complex. Again, that's going back to the maximum bearishness we had during the COVID-19 washout and continuing. Again, a combination of inflation, supplies, demand. Okay, one thing, I just think on the global scale, countries just don't have the money to go spend. Interest rates are a factor in that. It's a lot more hand-to-mouth purchases in terms of the export side. I think Paul mentioned it, or somebody mentioned if it wasn't for Mexico, we'd have really issues on the corn side. We aren't seeing those traditional buyers besides China, but Japan, okay, South Korea, Vietnam, Philippines, they're more hand-to-mouth in their purchases until those purchases are fading according to what we've seen in the past. Last couple slides, just quick touch on weather. Obviously, El Nino has been a major factor in Brazil. Okay, we can see the dryness that they've dealt with, but now weather forecasts have seemed to have get through. Early beans harvested have caused issues, but some of the later beans are coming along. Now the weather's improving for a potentially pretty good corn crop, even though the acres could be down. US, we do have still a problem spot here in the middle of the country, so we'll have to continue to watch that. I got to pick this up. I'm getting through speed. But summer weather right now is looking relatively favorable, but obviously that can change in a heartbeat. Lastly, on that South American crop, you can see the damage according to the vegetative indexes. But again, this is improving. We're still looking at strong South American production. Let's focus on the orange one. With the last USDA report, corn production, given the strength in Argentina, we could be looking at another plus 11 million metric tons or 430 million bushels than last year. Soybeans, given the current numbers, about 800 million bushels more than last year. So we'll have to see how that plays out. Now that soybean number is coming down, I still think, for Brazil, but that's still going to be a question mark going forward. So what am I telling producers? This is our last slide, just going through the information. Again, current situation is difficult, but the supplies, because the supply is softer tone, we want to keep balance in our marketing plan. Get control of those bushels at risk. I've been doing a lot of that lately. We got bushels on price. We're getting floors underneath them. Just protect here. Let's hope we're wrong. Okay, in that regard. Stay disciplined. Sell it when you hit your targets. Okay, don't use the hope strategy that we can go higher. Historical value might come into play, that things could get cheap and we could get on top of this market a little bit. Producers, again, need to measure that risk of doing nothing versus the cost of marketing tools and strategies, because things could get a lot worse. And right now, we're already talking about 25. You know, this trend could continue, so we need to make sure we're preparing forward. So with that, thank you for your time. Have yourself a great afternoon.
Lots of questions, I'm sure. So with all that down arrows, let's welcome Brenda Battelle up to the podium. She's one of my favorite folks from UW River Falls. She is the professor and department chair for ag economics and agricultural marketing at UW River Falls. She's an extension agricultural marketing specialist, in her area of emphasis, livestock marketing and price analysis. Plus, she's got a background in agricultural and applied economics and also an interest in international development. Let's get some good news going, Brenda. Give me a little beef and cattle update and see if we can't smile a bit.
All right, yeah. It should be an interesting, this is going to be a much better conversation than I've had sometimes in the past, right? So that always makes me feel better. First off, when we think about it from 2023, we saw meat supply basically down a little bit in the whole. When we look at all the combinations between poultry, pork, and beef, we saw that meat supply, we didn't produce as much meat altogether in 23 as what we did in 2022. So what does that mean? When I first look at it from a consumption side, right, from a demand side, when we're looking at it for poultry, you could see that we were down a little bit here, even though we actually saw 23 production of poultry up about 1.3%, we actually consumed less in the United States. Most of that had to do with because we did see an increase in exports. I'll go over exports specifically, but we saw that basically where we saw that increase in exports, which meant we had a little bit less here in retail shelves in the United States. We saw the retail price basically of poultry up about 3% in 23 relative to 22. When you look at it, we're still, obviously, poultry is still obviously the lowest priced of all of our proteins relative to pork or beef, which the beef is the blue line up there, the red is the pork, and then the dotted line is the poultry line where you can look at it from there. When we look at from a price adjustment point, we've seen significant increases, but poultry is actually the one that's had some of the least amount of increases over time relative to beef or pork. When we look at pork consumption, basically, again, in 23, we saw a little bit lower. Our production was pretty stable, but because of the increase in exports that we saw, we actually saw, again, a little bit of a decline in retail consumption in the United States here. Retail price for pork, though, was down about 1.1%. So basically, when we're seeing demand going down and the price going down, basically with it, we're seeing basically a little pushback basically on demand for pork here in the United States. So that's really weakened. That's the one where we've seen in our proteins, the demand for pork is the one that's seen the weakest demand in 23. Again, that's where we're looking at it from a demand side for domestically. When we look at beef, we saw significant declines in consumption in the United States. Retail price for beef was up about 3.9% relative to 2022. The biggest thing is, though, even though we saw consumption for beef down, this is actually really surprising, and it's this amount of consumption and the price here actually surpassed a lot of expectations, meaning that demand is much stronger for beef than what we were expecting. We saw significant declines in production in beef, and the fact that we are still consuming this much, meaning that we did not export as much of that, and the prices there, we're still keeping a really strong demand. That's one of the big concerns I'll talk about a little bit here, but basically that's our big concern for when we're looking at for in 2024 is where is that beef demand? Is that going to continue to stay strong? As we look at whether or not we have recession, where we look at for inflation, where we look at for consumer spending and consumer savings is down. All of those impact basically then our meat demand, all right? Beef demand tends to be the one that's impacted the most because it is, as we see, the highest price. So when that impacts it, we look at this. Last year, if you call, I said, oh my gosh, we're gonna really can see some pushback on beef demand in 23. Guess what? Didn't happen. So I hope it does not happen still in 24, but it is something that we do have to be cautious about whether or not we're gonna see some pushback on those high prices. Again, we've had record prices for beef. Record prices were occurred in 2020, at the end of 23 for those beef prices, hitting on an all fresh beef supply price of $7.94. So really, really high prices, but still a lot of demand out there. Where are we headed then? If we're looking at it into 24, well, that's really kind of weird to look at. Our fresh price, we're still going to see high prices of beef up about 4.6%. We'll see pork prices down a little bit in 24, and we'll see poultry prices down a little bit in 24 as well. The biggest concern that we have is, again, whether or not we have weaker domestic demand, which ties in a lot with consumer expectations and whether or not we have savings. All right? Let's look at it from an international side for exports for poultry, basically, where we're looking at for broilers, for chicken, basically 2023 exports should finish pretty much on par, just a couple thousand, 100,000 pounds different, so pretty much on par with what we had for 2022. Turkey exports is where we saw the huge basically changes, and they've significantly rebounded, where we had an 11.8% increase. A big reason for that is, if you recall, in 22, we had a lot of change of those exports basically based off of avian influenza. Unfortunately, we've had a little bit of an impact on avian influenza at the very end here of 23. So there are some certain areas that have banned basically exports from Ohio and California for poultry at this point. But assuming we can get avian influenza back under control again and it doesn't go to the point where we saw it in 2022, we should basically see continued increase in exports for poultry in 24. All right, when we're looking at it for pork, they also rebounded in 23 to the point that we saw our exports go up about 5.5% over relative where they were at in 22. A large part of this is basically the lower U.S. prices in relative terms, but also in the idea that it was a lot of having to do with Mexico. 85% of Mexican imports of pork come from the United States. And we saw a big increase in our exports going to Mexico, which really helped significantly on the pork side for our exports here. All right, so that's one thing. We did see some increases as well, I saw a decrease in one of the other markets, which was Japan, but overall we did see those increases in pork exports, and we should hopefully continue to see that in 24. When we're looking at beef, beef and veal is the way it's reported. So, but beef exports, basically, we saw a significant decrease. Those were down about 14% relative to 2022. And basically, when we look at our imports of beef, which I don't have up here, we imported about 7% more beef into the United States than we did in 22. All right, so remember, what we export and what we import of beef are not the same. All beef is not equivalent. All right, so we tend to export higher valued cuts. We import lean products typically, and so they're not the same thing. What happens is, why are we down so much was a lot to do with, again, supply. We just are not producing as much beef. Couple that with the strong dollar, we saw that decline basically in exports. Where we saw it is in all of our top markets, so Japan, South Korea, China are our top 3 markets. The exports in those countries declined by 17 to 22% in 23 relative to 22. It's still there, it's just that we are not having as much product. That's the biggest issue that we're seeing right now when we're looking at it from the point of view for beef exports. What that means in 24 is we're going to be down again for production. So we will see beef exports continue to decline in 24. So if we continue on that path, it starts to get a little bit of a concerning if these countries start to find product in other places. But right now, it's not too concerning. It's an expectation given where our supply is for beef. When we look at production side, basically poultry, we should continue to see basically some increases in growth here. The biggest thing that we have to worry about, as I said, is whether or not the avian influenza continues. Otherwise, we should see increases both in turkey production. We should look at about a 1.3% in poultry altogether when we combine broilers and turkey. So we should be up about 1.3% there. Basically, where we're looking at it, the biggest thing then is what we're looking at is a pushback on wholesale prices, which is coupling in with those retail prices. So that's where we're looking for 24. It's a little bit of an issue here when we kind of come on the demand challenges. Profitability side for protein has a lot to do with more so of the diseases and whether or not we can continue to control avian influenza. With pork, where are we looking at for production? We should see moderate growth. We have the USDA found a little bit as far as for the breeding herd size here, and then coupled that with the bigger pigs per litter, we should see a moderate growth basically in our pork production in 2024. But where we get with pork production, the bigger concern is what is going to happen with the variability on the market that's related to California's Proposition 12, which is the Farm Animal Confinement Initiative. All right, so in order to be able to sell pork in California, you have to meet the guidelines for production that are under that initiative, which creates a lot of concern because California is the largest state from a retail demand for pork. And as we see the market adjusting to whether or not people can sell pork in California, if it doesn't go there, is it going to the export market? Is it going to retail shelves in other parts, in other states? There's going to create a lot of variability and a lot of uncertainty within that in the United States. All right, so at least through 24. When we're looking at beef then from a production side, as you can see up here, basically, when we're looking at it for 23, we basically saw steer slaughter was down, heifer slaughter basically was up, right? And then cow slaughter was basically up. So all that basically, if we're looking at it from a point, total slaughter is down, even though our dress weights were down. So we saw a lot less production of beef in 2023. We will continue to see less beef in 24. Mostly what I want to point out is here is when we look at this, the big thing that we talk about from the beef herd is we have not yet started to grow our beef herd. We still continued to, as you saw, increase our cow slaughter. We still have higher numbers of heifer on feed right now, which means that heifers are there. So we're not holding back those heifers to start growing that herd. So we are continuing to cull and to decline our beef herd. So when we couple all that together, 24, we're going to see another decline in production of about 5.2%. And unless we get weather that's conducive to being able to grow that, we'll see this decline in beef production for a couple of years yet. All right, so that plays into those higher beef prices. Where are we looking at it in Wisconsin? Just to give you an idea, so these are basically changes over the last decade. So total cattle on head recognized, we have total cattle of about 3.4 million cattle. That's all cattle on feed, beef cows, dairy cows, calves, everything. But for the last 10 years, just to give you an idea, we have actually increased over 10 years, we're up about 20,000 head. So that's about 7% in increases relative to where we were at 10 years ago, whereas the rest of the nation in that same time for beef cows is down about 3%. So we're kind of bucking the trend when we look at it from a point of view from beef perspective. We're growing that beef cow side a little bit more in Wisconsin relative to the nation. This just gives you some idea. I've talked about all of these, but where I see for prices going, farm prices, production, exports, retail prices for 2024. As I said, I've talked about all of them, but just to kind of give you some idea on expectations, at least in the directional ways for where I see for some of those going. When we're looking at 24, the big things I have that we have to think about, and this was the prices for first cattle. If you want, I don't know, just to give you percentages here, for basically we're up. We should see some profitability in some, at least in beef, provided you've got some control over the prices of your feeder cattle and that. Factors we need to watch: recession, Proposition 12, disease. Those are the issues that are going to be really people are paying attention to in 2024. Thanks.
That a girl, that a girl. Native beef. Now let's talk beef on dairy. Come on, Chucky. One of our best acquisitions. He is an associate professor, Department of Animal and Dairy Sciences at UW-Madison, also supported by the Dairy Innovation Hub. Chuck Nicholson's principal research responsibilities, economic analysis of dairy production, marketing, and supply chains, as well as policy issues, often through development and application of quantitative simulation models. Come speak like I'm a child, Chucky, and tell us what's going on. Good to see you, String Bean.
Yeah, thanks. I was hoping to get something better than you're my tallest agricultural economist or dairy economist, Pam, so thank you for that. So good morning, everyone. I'd like to begin by talking about the storyline for 2023. And that storyline for dairy throughout the US and in Wisconsin was not really the best storyline that we can imagine. So the industry has experienced a great deal of ups and downs over this period of time you're seeing there. And 2023 showed us more of the downs than the ups. So we saw farm margins that reached really record low levels. If you look at the margin of the milk price over the ration value, partly that was due to a drop from the record high prices in milk we saw in 2022. And then we also saw continued higher than average feed costs. And this maybe is a little bit of a washed out version of that, but that's 2023 highlighted there. And what I want to point out is, in my experience as a dairy economist, 2009 was always viewed as the worst possible year for margins. And we actually got down briefly in 2023 at a national level to something that was quite comparable to that. The only thing that was a little bit of a saving grace was that did not endure quite as long as it did in the 2009 downturn that we had, but it was actually still quite painful. Another thing that was not actually really helping us very much is that we had a downturn in dairy product exports on a volume basis. It's across products important to Wisconsin, cheese and whey in particular. And this actually isn't something that's that unusual. It typically happens, this is a rolling average, so it smooths out a lot of the changes over time, makes it a little bit easier to visualize what's going on there. But the high prices we had in 22 meant that we were experiencing some challenges in export markets that resulted in a decline in that. So that didn't help either. One thing that helped a little bit with the 2023 storyline was that we actually had a pretty strong increase in butter prices towards the end of the year, driven by some really record low stocks to use ratios for butter. Got up to some very high prices over the historical time period, and that actually helped with some of the price recovery that we saw late in the year. So 2023, not a memorable year in the positive sense, but let's now talk about the 2024 storyline. Okay? So we're starting to see the adjustments take place that are going to make for a better 2024 in a lot of different ways. One of the things we look at is what's going on with the numbers of milk cows out there on farms in the top 24 states. You can see through the data we have for November that has been trending down. That's part of that long-term adjustment process. We also are looking at the milk per cow, which actually held pretty steady across the 2 years that we're looking at here. But one of the things that I want to kind of make sure folks are aware of is even if we have the same milk per cow, we're actually making more milk components. Over the last 10 years, we've seen a very significant increase in the amount of butterfat and as well as the other components of milk. And so if you plot it on a component basis here, looking at butterfat, even though we had the same milk per cow, we actually had more butterfat being produced, and a lot of that butterfat was actually being absorbed into the marketplace. And despite that high price spike late in 2023. Okay? So we also have seen some favorable signs for 2024 in terms of the export markets. Our prices are now back in terms of being competitive with some of the other suppliers in the marketplace. These are cheese and butter compared to the EU and New Zealand. You can see that the US has moved into a favorable position that we weren't necessarily in at the start of 2023. It's actually part of the reason that that decline happened and the rolling average for exports was those higher prices early in 23. Same sort of story is being shown here with non-fat dry milk, skim milk powder, and with dry whey prices. So we're in fairly favorable ranges for now as we headed into the end of 2023. Okay? A number of the previous presenters have talked about the importance of exchange rates for US exports of all ag products, dairy in particular. We actually have a little bit of a mixed story here where relative to some of our major customers for dairy products, China and Mexico, we're moving into more favorable ground on the exchange rates. There's a little bit of an appreciation against the euro for the US dollar, but in general, sort of a favorable position there. So one of the other things that I like to look at is kind of where we are in the dairy price cycle. And if you think about the major shifts that we've seen in dairy prices over the years, a lot of that is being driven by what we think of as cyclical behavior, like long-term swings in the price of farm milk. And this graph, I felt bad about this until I saw some of John's graphs, things with how complicated this was, but this is actually trying to show you basically over the last 3 price cycles how things have moved down and then they've started to move up in terms of this big cyclical component in the milk price. The dark black line is kind of an average of those last 3, taking out some of the weird stuff that happened during the COVID price cycle. And the dark red line is kind of where we are right now. So what it seems to me looking at this is that we have moved past the worst part of that price cycle and we can start to think about the factors that are going to make for an upswing supported by the data that I showed you, particularly on the number of cows that we have and the milk per cow. Okay? So we also still need to think about not just our own production responses, but we need to think about the global situation. We're starting to see some adjustments on a global level where milk production overall is down in the major suppliers. That's also portending some stronger markets for us. We are seeing a similar pattern in terms of global milk prices and their equivalent. So we reached a peak back there in 2022, hit a bottom point globally. The US tracked along with that to some extent. And now we're starting to see a bit of an upswing in global markets and US markets. So all those are good things for the 2024 storyline. The one place that's maybe a little bit less positive element for the 2024 storyline is what's going to happen with feed prices. Those are projected. These are, you can get a lot of different values. John will probably maybe say something different about this, but these are the futures markets projections of a ration value for dairy from the dairy margin coverage tool going forward through 2024. And what that tool is projecting based on futures markets is we're going to see a little bit of a decrease in the beginning part of the year, a little bit of stability, and then maybe some slight increases later on. But the key storyline is we're going to be above the long-term average for that ration value. So even if we see some strengthening milk prices, that's not necessarily going to make for super good margins in 2024. So with that, I want to fully agree with what Steve said about don't just trust one forecaster, trust a bunch of forecasters to get it in the zone. So I'm showing you here forecasts. The first of the bars there is USDA's all milk price forecast for 2024. And superimposed on that with the blue bar is sort of the expected margin of the milk price over the feed cost. And what USDA is projecting is basically a margin that is like right at the long-term, the 10-year average for the difference between the all milk price and the ration value. I have a number of different statistical models that I use to try and forecast prices that give me some different outcomes there. The next three bars sort of show you that same idea of a all milk price during 2024 and a margin. And you can see somewhat like what Steve presented, we're straddling the line across where USDA is with some forecasts that are a little bit above or a little bit below what that looks like. And of course, here in Wisconsin, the all milk price is great for the nation, but we want to think a lot about the class 3 price because about 90% of milk in Federal Market Order 30 goes into cheese. So the bars off there on the right are showing you what's looking like the class 3 prices projected by USDA and a little bit more pessimistic view that's coming out of the futures markets from CME, okay? So the storyline looks a little bit like this. The margins in 2024 should move closer to those longer term averages. We should see higher milk prices certainly than we saw in the lows of 2023 based on both the price cycle analysis and the overall forecasts. But the feed costs being above the long-term averages will be a little bit of a challenge for the profitability, okay? So other folks have done a little bit of the same kind of thing. I'm going to call these things wild cards that can affect up or down the basic storyline that I'm giving you for 2024. Okay? It's been mentioned a number of times already, the uncertainty in the global economy that affects the demand both domestically and globally. Interest rates and inflation will affect a number of different things. The economist going into the end of the year basically was looking at the US economy and saying, nobody knows what's going to happen. I'm glad Steve set the record straight that we know what's going to happen based on the consensus. But of course, this was actually also the same group that said we're totally going to have a recession globally in 2023. Looking at another source of information, the World Bank puts out economic projections for many of the different countries. They're actually projecting something similar to what Steve had suggested in terms of slowed but continued economic growth, both in the US, the developed economies, and then in our major export markets. So there's a little bit of a positive sign there. El Nino was also mentioned by John. I'm not going to go into a great deal of detail of that, but we do know that the heat impacts of El Nino, the precipitation impacts of El Nino can have significant effects, not just in the United States, not only on dairy cows, but also on the availability of feed supplies. The Climate Center is actually predicting that we actually might move from a strong El Nino now to something that's a little bit more moderate that might moderate some of those impacts. But again, take that climate forecast for what it's worth. Another thing that is a little bit different than those global things is something that we're doing right here at home. We have a series of hearings that are being listened to by USDA to think about proposed changes to our federal milk marketing orders. For those of you who don't know what a make allowance is, don't worry about it. But what it is part of the equation that's used to figure out how you take a pound of cheese and turn it into a milk price that looks like a class 3. And just based on a rough calculation, the proposals that are currently being listened to by USDA, not decided on yet, actually have the potential to have a fairly significant impact on the class 3 milk price based on changes to those formulas, that thing I called the make allowance. This shows that if you implemented a number of the different proposed changes and you did it for December 2023, you'd actually have a class 3 milk price that's more than $1 less than what it actually turned out to be under our current pricing formulas. That's a significant change, and we have to be a little careful because first, USDA has not decided to do that yet, and we won't hear more about that until the end of the year. There's a consensus that we need to make some of these changes. But we also need to keep in mind that if the milk price for class 3 goes down by $1, there's going to be some production decisions that change over time, and so the impacts will have to play out over time, and we should see some offsetting effects that would bring that class 3 price back up. Another policy issue that's being considered at these hearings, and I think it's the other major one that could affect milk prices going forward, is what are called Class 1 differentials. If you don't know what a Class 1 differential is, don't worry too much about it, but the basic idea is that if milk is used in a beverage, the buyer of that milk has to pay a higher price. That price varies based on the space in which that milk was received. This rather complicated map actually shows an analysis that was part of my testimony at those hearings, suggesting that we actually do need to think about changes in the Class 1 differentials, especially increasing them based on changes in the spatial value of milk in different parts of the U.S. The biggest increases actually take place in places like North Carolina and through that Mid-South area. But in Wisconsin, we're actually looking at milk value that's a little bit different than what the current regulatory system says, of up to $1.70 a hundredweight for milk used in beverage use. So that's actually another significant change there. Again, I think there's a consensus that we need to make some of these changes, but there's also issues about what should the base be. Currently, that base is 160. Some people say it should go up. Other people say it ought to go to 0. So we have to watch out for how much of that additional value we can get out of the marketplace for beverage milk, given that that's a declining segment in the industry. And finally, if you like the 2018 Farm Bill, congratulations. You'll have more opportunities to enjoy it through 2024 at least. So the key things are, do we have enough time? A lot of folks are saying, no, we're probably going to look at not getting the Farm Bill done, maybe even in this calendar year. Nutrition programs are a growing issue for the bipartisanship that's typically been characterized this process. I think for dairy, the major thing is that we're probably not looking at a lot of major changes in the policy space for that. So one last thing that I want to say before I close is that we often forget about some of the programs that can be very important for dairy producers. And in 2023, the Dairy Margin Coverage Program was really important for dairy producers in Wisconsin. We saw that big drop in prices, didn't completely cushion the blow for sure, but there was significant participation in the Dairy Margin Coverage Program in 2023 by Wisconsin farms. And for the farms that were enrolled, on average, if you look at the total payments that are projected and the total milk covered, that actually was more than $1 a hundredweight. So that was actually a fairly significant cushion for a fair number of farms. So with that, I'm going to put that contact information up there and hand it back over to Pam.
Brenda, John, come on back up. Before we break for lunch, let's light up the panel with a few questions. You can go any direction if you stop and take in everything that they were discussing overall. And again, remember the microphones are placed in the room. No dairy on beef, Peapod? Give me a little bright spot. Otherwise, they're going to get ready to hang themselves. Milk production report for December comes out today. And you think that could be a leading indicator of what is going to happen first quarter?
Very possibly. We'll have to see what the numbers are in terms of production and cow
He
numbers.
does dairy too.
Yes. And beef. And
Yeah, yeah. But we've talked about that before on, could be a telltale sign, not just here, but globally.
very much so. Yeah.
What, you don't want to step on Chucky? Globally? What do you think?
No, I think so.
What do you think? Forecast for me. Are we going to see milk production go up, flatline, down? It comes out this afternoon.
Down.
You're just playing to the crowd. Yeah. What do you think, John?
I would agree. I mean, with the cow numbers coming down. I mean, throw in weather.
Dairy on beef, Brenda? How much of an impact that's going to be on not only price, but consumption? Because I know you're talking largely native beef, but dairy on beef is what's been lighting up Wisconsin.
Yeah, dairy on beef is a big impact, particularly in Wisconsin. From a national perspective, it's something we talk about, but still in relative terms, that's going to be a small percentage compared to native beef, for example, as far as our beef supply. But it is a big impact for Wisconsin, just the way in which it's working. One thing that's really nice is that now in the last year, USDA has kind of started putting in some of in their contract, so you can actually go out and to start to track some of on a national level, some of the basis differences. Before, we really couldn't do that. We had the choice of dairy or we had beef. Now they have that dairy on beef in those reports. So for the last year, we've been able to look at a little bit of those differences in prices and see where that's happening.
I'm curious, this question comes from seeing some of your poultry numbers and John talking about pork and that before. How much of that industry is still held in private hands? Poultry, pork.
At least I mean, both sides of them, the vertical integration, just the corporate purchases have just really minimized, and especially in the pork industry, the private producer. I know we deal with very few that are not contract raised or some form. Again, I think unfortunately the beef industry, because of some other demographics, could be headed that way as well. When you looked at your cattle numbers, talking to the cattle people I see out there too, the age factor is becoming a big part of this. We're not seeing cow numbers because, you know, I'm talking to some of the older producers. They just don't want to fight it anymore, and they're going to go to the contract raise or the vertically integrated type operation. So that could be a factor we see going forward there as well.
Brenda, what about poultry?
I'm going to be honest on that one. I can't answer that.
I'm just guessing.
One thing
Not
where I
much.
would say, I'm going to add with John, where I think you see a lot more of those contractors in that, particularly in Wisconsin, is that dairy on beef. Is that, I think that's that chain there is much more defined, and you have to have that more integration when you're looking at that dairy on beef than you do necessarily when you're looking at native beef, particularly in other parts of the country. So that integration there, again, from a Wisconsin perspective, we're going to see that greater than we probably do elsewhere on a beef side.
Consensus on these federal milk orders, Chuck. I mean, what are we, this is the 11th week now, which we didn't necessarily see coming. And now you're telling me maybe we'll hear something by the end of the calendar year? Well,
So
clear as mud right now.
I have good news. Dana Cole, the administrator of dairy programs, says we are done on the 2nd of February.
Really?
Yeah. So the likely trajectory from here is they will finish the hearing, and then there's a very set calendar that has to take place of different steps, defined 30, 60, 90 days going forward. I imagine that we might have a recommended decision by middle, late summer, if all goes according to plan, then the follow-on commentary and final decision even by the end of the year. I'm not thinking that this will have a major impact if they do get that far in the process on the milk prices for 2024. But certainly as we think about the future, 2025, that's where we are going to be in a zone where those changes will take place. I guess the other thing is that we don't know yet what USDA is going to do. But I do think that they're likely to make some adjustments to those make allowances that would have an impact on the Class 3 price. And I do think they're likely to do something on the Class 1 differentials, which has a somewhat offsetting effect on a national level, but not as helpful for Wisconsin with 6% Class 1 utilization.
If nobody else is going to save you with the question, Little Mouse told me USDA will randomly select a date when they will conduct the vote on whatever recommendations they come up with. If you didn't pool milk on that date, you don't get to vote. Minnesota Milk, Lucas, Sostrom.
I have not heard
See,
that.
me either. That's why I'm
So
poking ya.
I can't confirm or deny that USDA plans to do that, but I guess I have faith in the folks at USDA that they have a very good faith idea about the process, and they are trying to hold up the scales of justice and be fair to both dairy producers and to dairy processors in this whole effort. But I will say that the hearing process has been extraordinarily painful for nearly everyone, with the possible exception of the administrative law judge
Yes.
who seems to have fun doing this.
I'm waiting for the before and after picture. Before they look like they're 16, after they look like me, after 11 weeks worth of federal milk, yeah. Anything else? Otherwise, there you go,
One
Paul.
quick question for John. This is the ARC and PLC signups are going on now, and this is the USDA's barking year average farm price. and they're going to project a new one here in mid-February is when they typically, and the floor for corn, the PLC price floor is 401. That's that season average, marking your average price for all farm. For soybeans, it's 926. Your numbers are somewhat pessimistic on corn, where that 401, what's your thoughts there? How close to that 401 floor is the marking your average price for farmers going to get at the national level?
Unfortunately, to be bold, I'm kind of in agreement. I'm very, very concerned for the corn market this year if we don't see the demand kick back in. We're going to see a forecasted production here for the March, acres number. First line trend line yield probably coming out the February outlook meeting will be like 182, 181. We start putting those numbers in. If we put over 90 million acres out there, we're going to have a monster pile, and we could very well be looking at 3 billion bushel carryover come next fall. Okay, that's going to put us back to the 14, 15 price window, at least according to those numbers and stocks to use. The big factor that's going to need to come into that obviously will be the demand. Now the USDA will reflect demand on the balance sheets as we get lower prices. That just incurs extra demand. But watch the South American weather. I didn't really talk about Argentina much. They're looking at a possibly 60 million metric ton corn crop after 2 years of consecutive drought. That'll be a record production. That's a country in need of finances. They are going to put that on the market at a very, very low price that we won't be able to compete with. So I'm pretty defensive of the corn market right now. I've been telling producers, hey, we got 475 out there for next fall. Make sure we're getting the floors in here.
Fellow farm broadcaster Larry Lee from the Brownfield Network. Good to see you, buddy. What do you got?
I'm going to follow up on your question, Pam. I believe it was Brenda's slide with the questions for all three of you. You mentioned that beef production is actually up in Wisconsin, but not so much everywhere else. Do we have a way to track how much of that increase is beef on dairy?
Okay, first off, beef production isn't up. Beef cows are up. We actually have less on cattle on feed right now, but we're bucking the trend as far as for not declining the beef herd per se, as what the U.S. is. Do we have a way of tracking what percentage of beef that is produced is beef on dairy relative to beef? I did some work on that like 5 years ago when we were able to track numbers a little bit more. It's the challenge, it becomes a lot more challenging to do that with, because the way that when those animals are marketed and the way the USDA reports it, they have a choice between reporting it as beef, as dairy, and now, as I said, now they have this mix, but that's only been in the last year. So as that grew, we really didn't have a way to be able to define, to say specifically what percentage of our beef supply is coming from beef on dairy. Long answer for your question.
Go ahead.
Hi, my name is Chuck Anderis. I'm with the Michael Fields Ag Institute. I'm just thinking about so the way these things, it's like the GDP, for example, grows over time, but there's localized failures of communities basically. And so I'm thinking the dairy market might be growing over time, but the dairy communities in Wisconsin are kind of hollowed out because it's all centered in fewer and fewer people. So I guess my question is the continued consolidation of farms and the growth of the amount of cows on a dairy farm, is that inevitable in the current political and economic system that we have? Or what kinds of policy tools do we have to change that trajectory so that we can have more than one dairy farm in a township?
I guess that's coming to me. So thanks for the question, and very much like your name. So one of the questions is the current structural change sort of inevitable in our current environment? And I would say yes. We're going to continue to see the kinds of patterns that we've seen for actually quite a long period of time. I did some analysis of the farm number data from back to 10 years, and for quite some time we've been losing about one dairy farm per day in the state of Wisconsin, and that accelerated a little bit more in recent years. I also want to link this a little bit to the question that Doug asked earlier about kind of structural change in dairy and farm size. And one of the things that I like to think about is the proportion of milk that's coming from farms of different sizes, kind of rather than the number of farms, even though that can be very important at both an individual and a community level. And we've actually seen a pretty steady trend in the US and in Wisconsin in terms of the increasing proportion of milk that comes from the largest farms. So the exact numbers elude me at the moment, but if you think about farms with more than 1,000 cows, we're probably talking about 2/3 or more of the US milk supply. So most of the milk is being produced on those larger farms. Second part of your question is really what are the policy responses that might help with that process? I would say that we used to have a dairy price support program whose main purpose was to sort of slow down the rate of structural change and try and make for a little bit more of a soft landing for particularly the smaller farms that were exiting the industry. Since we've moved to a more risk management based type approach to policy, we don't have quite the same support levels and tools in place. It's kind of better on the shorter term, but the longer term makes it maybe a little bit more challenging. So one of the things that I think we have as options is I'm also involved with the work of the Grasslands 2.0 initiative, which is sort of trying to envision alternative approaches to the scale and the production technologies used in dairy. We have some work that we'll be reporting on fairly soon here, talking about the likelihood of getting folks to do more grazing, particularly for heifer raising. So providing support for that, and I know there's a bill in front of the legislature to help support additional transitions to grazing. But I think we have, unless we're willing to sort of spend a lot of money or radically alter the nature of our supply chains, we have some challenges that would be challenges to completely changing that trajectory, although I think there's some things that we can do at the margin that actually might be pretty positive. So thanks for that.
Very good. Looking at the clock, we're going to have to pause on the wisdom up here. If you want to continue your sidebar conversations with any of our speakers from this morning, obviously, feel free to reach out to them. I'm assuming most of you are going to stick around for at least a little bit early this afternoon, so you'll have ample opportunities. I believe now is appropriate time for lunch. I'm going to assume that the catering staff will dismiss us by tables, and we will resume at 1 o'clock right back here. Enjoy your lunch. This is a 5-minute count. 5-minute count before we get started with our afternoon session. All right, ladies and gentlemen, I'm going to politely ask you to break off the conversations or take it out of the room. Have a seat. If you want to grab a bar or a cookie, this body will not deny you that. As they always say, if you don't eat it, part of the Clean Plate Club. So again, like I said, if you want to grab something to drink, a dessert if you didn't have the opportunity, but please do take your seat and silent your phones again. Welcome back to the afternoon of our UW Ag Outlook Forum. Now we're going to pivot and start focusing in on the aspect of rural livability and all that that entails and the interdependence that we've got on one another when it comes to that livability factor. My name's Pam Yankee, the fabulous Farm Babe. Again, I appreciate you being here, and I'm going to ask you again to take your conversations outside the room Or sit down, please. Thank you. That's you, Sarah. Move it outside or sit down. No, just teasing. We want to keep on schedule, and especially when we've got the special guests that we do this afternoon. I want to welcome to the podium a friendly face here on the College of Ag and Life Sciences campus. Dean and Director of the College of Ag and Life Sciences at UW-Madison is Dean Glenda Gillespie. She is the 14th Dean at UW-Madison's College of Ag and Life Sciences. Came to us in August of 2022, and I'm happy to say I was the first farm broadcaster that got a chance to visit with her. And at that time, she was just barely getting herself worked in at College of Ag as far as the office space. Before this, she was a professor of biochemistry at Virginia, served as department head since 2015. Ladies and gentlemen, with kind words for you, she is Dean Glenda Gillespie, our kickoff guest for the afternoon.
Thank you, Pam. I could use you whenever I am giving a talk and you could get everybody to quiet down. You're quite effective at that. Thank you very much. It's my honor to be here and introduce this next section of this lovely Ag Outlook Forum. I'm going to talk about three things. I was asked to give you an update from the College of Agricultural and Life Sciences, and I'm going to focus on three aspects, and then we're going to move to rural livability. So I'm going to talk about teaching, extension and outreach, and research. So first I wanted to give an update. I've got to give some numbers because I've heard all these great numbers this morning. So I just want to say one of our strategic mission areas is having an even greater impact on undergraduate education at UW-Madison. And I'm happy to say that our overall enrollment is up. It's up 5.5% from 2022. So we have 3,453 undergraduates. That's a big deal. We've turned around the decline of undergraduate enrollment in the college. And part of the way we're doing this is through innovating curriculum, making curriculum more flexible, more attractive to students, still doing all the great things we do, but allowing students to see themselves in some different roles. And so our newest major is Animal and Veterinary Biosciences. This major attracted 112 students without any advertisement and just coming online during summer orientation. So we're hoping to do more of this. And another major mission is fostering a student's sense of belonging. So just to update you, we have a project on the lower level of Ag Hall to update that space. Some of you may realize or remember that the old Ag library is part of that. And so we are undertaking a renovation project to create student-centric spaces, both for CALS students to give them a sense of identity and a home, but then also for other students. Hundreds of students come through Ag Hall every day, and so that'll be a great landing place for them. So this is what our CALS undergraduate profile looks like for this fall. Students continue to be just slightly different than the UW-Madison mean. So income a little lower than the average student, Pell eligibility rate a little bit higher. So we continue to do that. That makes these students different and valuable, and they bring diversity to the college. So we want to do more of that. Also, when you look at residency, also a little bit higher in-state, 51%, and the other numbers pretty similar. Those are students, many of them from rural areas, that are attracted to come to, in some cases, to our traditional ag programs. So they're an important part of diversity, and we really want to well serve those students. Okay, so what does the CAL student experience look like? We continue to take a lot of pride in the fact that over half of our students do a research internship or a different type of internship of some cases. Do you recognize some faces in the slides here, I see? So these are 3 different vignettes. I'm not going to go through the names. I'm just going to tell you a little bit about those vignettes. So a student working who's part of our crop judging team, students who collaborate with scientists in Thailand to create an easier way to make a very valuable form of coffee. You can see they're testing out this $100 a cup coffee, and it's because the beans have traveled through the digestive tract of a civic cat. And so what they're doing is working to take microbes and do that without the cats. So that's how you create value-added products in Thailand. And this is a vignette from a student who is interested in climate change communications, building a career there. And this is a really outstanding student who's received NSF reward for some of the work that she's doing. So we're super proud of our students. So in extension and outreach, we continue our excellence. We have 45 faculty who are extension funded and 10 academic staff who are extension funded. Now, these folks are pretty unique, I think, in the whole USA because they engage in research here on campus in super modern, impactful lab programs, and then they take that knowledge out to the state and they help farmers, growers, and producers solve practical problems. And then here's the other piece. They bring that knowledge back to campus. These are the problems and issues, and they share that with their colleagues, and that creates a very robust agricultural research station. And I really think this is the paradigm. I think we do this the best in the world, and so we're super proud of that. And I just wanted to very quickly mention our new faculty, our newest faculty in this area. Malika Noko, water quantity is her focus. Natasha Rain, soil fertility is her focus, and Stephen Hall working on water quality. And we have an ongoing search for a corn agronomist. And a quick word about our new Ag Forward. It's part of our Farm and Industry short course revival. And this is a photo of the part of the program that ended last week. So students from the River Falls FIS came down, and we also invited many different stakeholders. This is a graduate student talking about animal ruminant nutrition. And this is really going to be, I think, our signature program. Heather Gayton is there, and Doug Reineman, thank you very much for running this program. I think it's going to be our signature program. It's how we impact stakeholders, not by just focusing on early career farmers, but opening the doors for farmers at all stages of their career and professional development. So research, we're great. $186 million awarded to cows in fiscal year 23. We're the third highest federally funded research expenditures in the U.S. We continue to do well there, and I think we will keep progressing in that. Troy Rungay, our Associate Dean of Research, held some visioning sessions so we could think about what are we really great at? How do we want to impact the world? So 2 areas, sustainable agriculture, where we think we can really make inroads on decarbonizing food production systems, improving water sustainability, and developing innovative crop and livestock systems. Part of that is for climate resilience. On the health side, the more life sciences side, feeding the world through plant biology, healthy aging through looking at the gut microbiome and nutrition, and preventing vector-borne diseases are areas where we're really poised to have big impacts. And I just wanted to tell you about 3 noteworthy funded projects. The first is $26 million that came through a federal appropriations process. Senator Tammy Baldwin is important for that, to our Center for Dairy Research. This award is called the Dairy Business Innovation Alliance, and it's really meant to increase dairy profitability, both for farmers and both for producers and for cheesemakers and other. So this is a super neat award. About half of this is given out in grants, and the other half will be used to help provide staff for educational purposes, and then also for equipment. And in particular, we're going to get biofermentation equipment. The middle picture shows you Assistant Professor Leslie Holland, who's in our plant pathology department. She won a NEFA $4.1 million award to look at cranberry fruit rot, which is a really incredibly important pathogen. Over 75% of cranberry producers have issues with this. Leslie's going to bring her expertise to bear on that. And then last, and relevant for today's topic, is our $9.3 million award for the Rural Partnerships Institute. For short, we call that RPI. And I want to tell you a little bit about that. So at the federal level, there was a little bit short of $30 million, also through ag appropriations, and we can thank Senator Baldwin again for the first kind of bolus of money there. And it went to 3 institutions. It went to Auburn University, the University of Vermont, and UW-Madison. So we were very fortunate. And the funds are to have research and outreach focused on social and economic problems, increasing vitality of our rural communities. So this is what we're doing in Wisconsin. We have, as many of you know, 1.5 million residents that face unique challenges because of being in a rural area. Also part of this initiative is to have both research, but also these community-based initiatives. So let me tell you what we're doing, what we've started doing, and we're about at the end of our first year. It did take us a while to deploy some funds. So we have 5 funded projects. The first focuses on community health workers and work care systems. And I forgot, I needed to mention that this is a collaboration with the Division of Extension. And that's actually a super exciting part of this, is having a common goal and working together with Extension in a new and different way. So all of these 5 projects involve Extension. Many of them involve cows. And then the other important thing is they involve all the expertise on campus. These were open calls. Bring us your ideas. How do we really impact rural citizens in the state of Wisconsin? The second project is on indigenous food resilience systems. The third is on mental health support for children and families in rural Wisconsin, an incredibly important area. The fourth is something called WiscoNet. And this is a series of weather stations that will go up all over the state. I think we have upwards of 20 or so that are already deployed. Many of you may know about this. There was a lot of excitement. The idea is to collect a lot of data that will be useful for farmers and decision making. And also another part of that is helping to stimulate the Wisconsin State Climatology Office. And if you have not heard of WiscoNet, you can Google that, and they have a great website where you can get lots of information on weather. And then the sixth is very important for our topic today, which is the Rural Livability Project. So rural livability, rural communities face many unique challenges: schools, healthcare, housing, childcare, businesses. How can they remain solvent? And so today's goal is to better understand those challenges and to figure out what rural communities are doing and what leaders and experts can do better. So we're going to hear from leaders today in both public and nonprofit sectors that are interested in maintaining, invigorating, revitalizing rural life. The first panel focuses on Wisconsin, and then the second panel, things outside of Wisconsin. I just want to close by saying I'm very excited about this. I'm actually the project lead on the Rural Partnership Institutes. I meet with the project leads from Wisconsin and Vermont. We're going to have those entities come and visit us in summer of '25. I think this is a chance for cows and Extension to really serve the state in a novel way. So thank you for your attention, and now let's get started on our panels.
Lots of ground to cover yet this afternoon. Before I forget, and one of the first speakers is going to emphasize the work already being done in this. Is Carl still around? Carl Martin? Or did he blow? Huh? Oh, there he is. I didn't get a chance to say hello and welcome to Dean Carl Martin, University Extension Dean. As we roll through this afternoon, you're going to find that he has had to maneuver a lot of different angles and challenges to make sure that University Extension remains relevant here in the state of Wisconsin, and rural livability is a major element of that. Matt Kuris can tell you all about that. He's a distinguished community economic development specialist and researcher, UW-Madison, under the Community Development Institute at UW-Madison's Division of Extension. He works in partnership with the Extension's network of specialists across the state, different resources, working to help communities and organizations in the areas of regional economic analysis, labor force research, and industry sector competitiveness. Put that all together, and that's rural livability. Matt, welcome to the program.
Good afternoon, everyone. It's my pleasure to be here this morning to talk with you about rural livability, which is a topic that I have a lot of interest in. I've been working with rural communities in Wisconsin for more than 20 years, and I've seen a lot of changes in our communities that are some good in some ways and not so good in other ways. And I think this is a real opportunity for us to really move our rural communities forward by understanding some of the assets and challenges that they face. And the Rural Livability Project is something that was obviously spearheaded by the Institute for Rural Partnerships, and we do thank Senator Baldwin's office for getting this project off the ground. But I do also want to note that this work is also being supported by Dr. Tessa Conroy, who is the PI on this, someone that has a lot of interest in this topic as well, and will be a great resource for this initiative going forward. Now, think about rural livability. Livability means a lot of different things to a lot of different people, and it could almost be somewhat of a loaded word. If we say that rural areas aren't livable, that connotes that everything is bad everywhere in rural areas, and we know that that's not true. So we're trying to understand why some communities are more successful than others given different topics and different measures. So really we're trying to have a better understanding of the factors that contribute to both those rural challenges and those rural successes. Now, unfortunately, when we talk about rural areas, many times we face this narrative that there are a lot of negative things going on. We're having depopulation. We're facing industrial restructuring. We have high mortality rates, low housing availability, and all these other challenges that we hear about from time to time facing rural areas. But we know that that's not true everywhere. We know that there's many communities throughout the rural continuum that are doing well in many different areas. And really the idea is, how can we learn from those places? How can we find case studies or outliers that really help us move other communities forward by learning from those successes? And we also want to understand factors like regional interactions. We want to understand path dependency. Are there paths that communities go down based on decisions made a decade ago or 2 decades ago that impact their ability to succeed now? And then also, how do we better understand the outcomes of livability from the drivers of livability? So many times we think about a community in terms of how successful it is based on whether or not it has, for instance, a vibrant downtown. Now, is that vibrant downtown an outcome or a driver of livability in that community? And finally, based on all this research that we'll be doing over the next couple of years, are there opportunities for us to create blueprints or other strategies for communities that they can learn from and implement in their own communities to help them move forward and grow? Now, one of the challenges is, how do we define what's livable? And again, that's going to be different to different people, and it might be different to different parts of rural United States and rural Wisconsin for that matter. And many times when we think about what makes a community successful, we like to focus on kind of traditional economic measures, things like population growth, the number of jobs or number of employment opportunities in the community. How high is our income? Are our wages growing? And what's our gross domestic product? Now, those can be good measures, but we also know that not every place that is growing is necessarily doing well or is necessarily livable. We also know that some places that are somewhat stable in their population may be very livable as well. We also know that there are places that have very high incomes that are not very livable for a lot of people that either live there now or may want to live there. The other challenge we face is that when you use a lot of these traditional measures, it follows a kind of traditional blueprint for how we think about community economic development. We think about the fact that if we attract these businesses or attract this investment in our community, it'll help grow population and jobs, which may happen. We also have to think about the fact that we don't always follow that pattern. We have to think about whether or not people follow jobs or jobs follow people. And if jobs follow people, that is, if people are picking quality communities to live in for one reason or another, that is something that's different from simply looking at whether or not employment is growing in our community. So let's think about some different ways that we can think about livability going forward as part of this initiative, and I think a number of other speakers will build upon some of these themes as we go through the afternoon. So just kind of a big picture perspective. Let's think about percent change in population by county from 2000 to 2010, so the prior decade. The darker the red, the higher the percentage growth in population in that county on a percentage basis. The darker the blue, the greater the percentage loss. Now, if we look across the country, we do see a number of patterns. We see certainly growth throughout the Sun Belt. We see growth around large metropolitan areas. But we do see in rural areas kind of a variability in growth rates. Now let's step forward to the next decade, 2010 to 2020. So again, we do see some of those similar patterns existing, but we also see that there's a number of shifts that happen throughout the United States in terms of population growth rates, with growth rates slowing in a lot of places. And in Wisconsin, we also saw some places that were negative in their growth rate in the prior decade that went from negative to positive. So they went from a population loss to a population gain. So the question is, what are some of the factors that are driving that? And again, is that necessarily the measure that we want to use to define what's livable? The other challenge we face is an issue of definition. How do we define rural to begin with? So a lot of times when we think about rural, we try to divide places into metropolitan areas and non-metropolitan areas. So this looks at those areas that are part of a metropolitan statistical area in the state of Wisconsin and how that's changed over time. And we see that the dark red counties are those that were part of an MSA back in the 1950s, all the way up through kind of the lighter red, the pink, to the most recent changes in definition to MSAs. Now, what this also means is that rural communities evolve over time. They may not always be part of that same definition. And this is somewhat problematic for a couple of reasons. First of all, let's just look at how this has changed over time using the current MSA definitions, or the most current definitions we have for the state of Wisconsin and the United States. And going back to 1970 to see how population has changed. The orange line, oh, we're losing our part of our legend here. The dark orange line you see there are the non-metro counties in the state of Wisconsin. The light orange lines are the non-metro areas in the United States. So you'll see that over time, especially coming out of the 1990s, our metropolitan areas grew faster than the national average. We can also see that our non-metropolitan areas grew faster than our metro areas. This changed more recently coming out of the Great Recession, but for the most part, over time, they grew faster. However, both areas grew much, much slower than the metropolitan areas on a national basis. Now, this uses those constant definitions from 2023. Let's go back and see how this has changed using 1970 definitions and using the most current definitions we have, and for the state of Wisconsin. So here we have the current metropolitan definitions and the current non-metro definitions, and we saw that on the same slide before, that growth pattern over time. But what if we go back to 1970 and just use those counties that were metro areas then? We can see a different pattern then. We didn't see that rate slow down. We actually saw that growth continue to occur using those definitions and continue to grow faster than our metropolitan areas. So why does this matter? Let's think about those metro counties that have been added more recently to the definitions in the state of Wisconsin. We see places like O'Connell County, Kewaunee, Iowa, Greene, Pierce, Lincoln, Columbia. This is the share of residents in those counties that live in rural census blocks. And we can see in some counties, it's over 0.75%. So would we call these counties urban? I don't think so. We can also look at a place like St. Croix County, which has been part of a metropolitan statistical area for a long time. And we can see that almost 2/3 of the people living in St. Croix County, one of the fastest growing counties traditionally in the state of Wisconsin, live in rural areas. So again, if we just simply try and lump communities or places into a definition based on kind of these federal categories, we're probably missing some nuances of what's happening in communities. Now, the reason that some of those areas were included as part of the MSA definitions is because of their commuting patterns. If they send a certain share of their population into a core county in an MSA, they become part of that MSA. So here we're looking at kind of the commuting networks across non-metro counties in the state of Wisconsin, and we can see that there are very, very intricate commuting patterns across space. We can see that non-metro counties send a lot of people into surrounding counties, as well as into metropolitan counties that may be a further distance away. So when we think about rural livability, we can't just think about our communities in a silo. We have to think about how they may interact with the economies around us as well. And we can see that this has changed over time. This is the share of residents in a community, in a county commuting to another county for their place of employment. And we can see back in 2002, there are many counties that did have a very high share of people commuting out for their place of employment, but that has grown over time. and we see very high shares in many Wisconsin counties, especially non-metropolitan counties across the state. So again, how do these changes impact livability, and how do these interactions across space and across time impact how we think about whether or not a community is succeeding or not? Let's use another one of those traditional measures, change in wage and salary employment. Let's use metro and non-metro areas. Here we can see that Wisconsin's non-metro areas grew faster in wage and salary employment over time than our national peers. We can also see that traditionally our non-metro areas in the state of Wisconsin in terms of employment grew faster than both state and national metro areas. But we can see that with the onset of the Great Recession, we dropped and we've never come back in our non-metropolitan areas. We still have yet to reach our full employment prior to the Great Recession in our non-metropolitan areas. We also see how our metropolitan areas have increased in employment over time and have now caught our non-metropolitan areas. Okay, so why did this happen? We can think about this from different perspectives, and again, this influences how we may think about livability. Let's think about one aspect of industrial restructuring. Let's look at change in manufacturing employment in metro and non-metro areas over time. And we can see that non-metro areas grew very heavily in terms of manufacturing employment over time. We're hit very hard with the turn of the century. We're hit hard again with the Great Recession, but have come back. So this maybe we have to ask the question, is this a dependence? Is this a sign of resilience? Or is this an opportunity given to some of the changes we're seeing to supply chains and reshoring and so on and so forth? Again, do we have the answer to this? No, but these are the types of factors that we have to consider and what may impact a community's livability going forward. We can also think about whether or not this lack of employment gain is due to simply labor availability. This looks at change in total working age population, so the population aged 15 to 64 from 2000 to 2022 estimates, as well as prime working age population, individuals aged 25 to 54. And we can see that in terms of total working age population, there are only 12 Wisconsin counties that have an estimated growth over this period. The other ones lost total working age population. There's only 2 Wisconsin counties that have an estimated growth in their prime working age population, Dane and Eau Claire. And we can see very significant losses in other counties. So again, is this inability to grow employment back to the pre-recession levels a factor of industry composition, or is it a factor of labor availability, or just something else altogether? We can also think about how other ways our population has changed in rural areas. Here we have population age 65 and over by county from 2000 census up to 2022 estimates. And again, we kind of see the flip of what we saw before on the prior map, growing shares of individuals age 65 or older or at or nearing retirement age in many Wisconsin counties, particularly in our rural counties in northern Wisconsin and central Wisconsin. So these shifts also have to make us think about livability in terms of livability for who? Are we trying to be livable for young workers? Are we trying to be livable for retirees? Are we trying to be livable for everyone in our community, regardless of their age or their demographics or their other contributions to the economy? So again, these are the types of questions we have to ask ourselves. So when we think about this, we also have to think about if we're trying to address livability for different people, people depend upon different critical institutions. They depend upon industries like healthcare, education, pharmacies, veterinary clinics, broadband, banks. I was in Campbellsport a couple months ago. They talked about how they lost their lawyer in town, and that was a big challenge for a lot of people living there. So as we think about how we may have lost a lot of these institutions in our rural communities, what does this mean for a community's ability to retain the people they may have there or attract new people that may depend upon these types of critical goods and services? Let's end talking a little bit about how we might identify livable communities and think about people's behavior. We can think about things like places that may have a high in-migration. Is that a signal that people want to live there because they're coming there? We can think about low out-migration. Is that an indicator that people who were there that want to stay? Or perhaps maybe they face barriers to moving that may have otherwise moved for one reason or another. A stable or high birth rate, home value appreciation, new business startups. All of these may be some sort of indicators of rural livability based on people's actions living in those places. Okay, so let's just take one. Let's look at migration real quickly. So here are net domestic migration rates by county. So in the year prior to the start of the pandemic, The darker the red, the higher the net migration rate on a positive basis for that county. The darker the blue, the greater the population loss due to outmigration. Now, this is net migration, so we don't know if these changes or these values are due to people who may have moved there or people who may have stayed there who may have otherwise moved. So we don't know the in and out differences. Okay, let's step forward to the period after the start of the pandemic. We can see that there were many Wisconsin counties and many other counties across the country that went from negative to positive, or went from positive to even a greater positive rate. So we see many more dark reds throughout the state of Wisconsin, as well as in other places. And we see a similar pattern from 2021 to 2022. But we don't see this across every rural area uniformly. And we don't see every rural area went from negative to positive or grew in an even greater positive way. What we can do is look at some other characteristics that may have influenced these differences. So let's think about seasonal recreational housing. Let's think about natural assets that may be there and use the share of seasonal recreational housing as kind of a proxy for attractiveness to natural assets. And we can see that many Wisconsin counties have some of the highest shares of seasonal recreational housing of any place in the entire country. Some of the highest numbers as well, especially in northern and central Wisconsin. So let's look at just those counties that are considered to be what are called recreational counties in non-metro areas and compare them to all non-metro counties that are non-recreational and look at the patterns for net migration. Here we can see that non-metro, non-recreational counties did not see the growth in net migration that we saw in non-metro, non-recreational counties, those orange bars. We can also see that this was a pattern that started before the pandemic, but was exacerbated after the pandemic. So one of the things we see here is that this is an indicator in some way that people want to be in these places that have these types of assets. Now, does every community have these types of assets? Not necessarily, but they do have assets they could build upon that might be a lesson for other communities that are trying to shift this population dynamic. Finally, we can also think about what are known as community capitals. We have all these other assets that are available in communities that we can measure and we can learn from in terms of how important they are for livability. So we have natural capital, which may be natural amenities, which is talked about, built capital, which would be critical institutions, infrastructure, housing, social capital, how people interact with one another, human capital, the skills and education that people have that are living in the community, what are their mental and physical healths as well, cultural capital, political capital, financial capital, and so on and so forth. All these are different factors that can influence a community's livability, and how can we better understand how we measure these and how we can determine whether or not they are drivers of livability in different communities across the rural urban continuum. And finally, our hope is that with all of this, we can take this information and create what are called typologies and potential blueprints for communities. So if you're a community that has these types of assets that may be, for instance, high natural amenity, older demographic, high income, large tourism industry, are there specific initiatives that make better sense for you than other places that you may want to undertake to help make your community a livable place? And we're going to try and do that for many different rural areas across Wisconsin as well as the United States. With that, my contact information is there. I'm happy to answer questions later on after we're done, and I want to thank you all for your time. Thank you so much.
Lot to think about if you just think about your own personal life. Where do you go on the weekends, and that kind of thing. Very good, Matt, thank you. Marie Berry is up next. She's the Director of Community Economic Development at the Rural Wisconsin Health Cooperative. She leads their efforts to utilize one of rural communities' greatest assets, their hospitals, as a driver of economic development. They're also a cooperative of 44 rural hospitals across the state that provide shared services and act as an advocate for their member hospitals for over 40 years. One of probably the greatest challenges that we're facing in rural Wisconsin, just all of those services and who's going to coordinate and share with one another. Very interested to hear your message. Marie Berry, please welcome her.
Thanks, Pam. It's an honor to be here this afternoon. I'm excited to talk with everybody. So first, a little background about our organization. We're a true cooperative of 44 rural hospitals. One of my favorite facts is when we formed in 1979, they took dairy cooperative bylaws, crossed out farmer, wrote in hospital, and hit the ground running. So if that's not rural Wisconsin, I'm not sure what is. We're unique when it comes to rural healthcare organizations because we're structured as a cooperative, not an association. So we primarily provide shared services to rural health hospitals to help strengthen rural healthcare delivery. So very similar than some of the agricultural cooperatives that help strengthen your farm enterprises. We're also unique in that we have half system affiliated hospitals and half independently owned and operated hospitals. So we have some Gunderson Bellin hospitals, HSHS hospitals, Marshfield, Aspirus, and SSM, and then those independently owned and operated hospitals, which is unique across the country that we see a high level of coordination and collaboration between those two entities and really helps to strengthen the rural healthcare ecosystem in Wisconsin and elevate the idea that rural hospitals are stronger together rather than competing with one another. And the vast majority of our hospitals are critical access hospitals, which means that they're 25 beds or less and targeted at 72-hour stays or less. So that gives you an idea of the kind of services that they're providing to their communities. So I wanted to start with kind of a high-level overlook of what does the rural healthcare landscape look like in Wisconsin going into 2024. And I don't have the fancy charts of the ag economist, so I think I still have something to offer in this space. So the good is that Wisconsin has seen a lot of preservation of rural healthcare access. When we look at other portions of the United States, specifically the southeast portion of the United States, we've seen these rashes of rural hospital closures and whole counties or multiple counties that don't have access to healthcare services. And Wisconsin has been able to preserve many of its rural hospitals and clinics and ensure healthcare delivery in rural communities, which is very positive. We also rank incredibly well in terms of the quality of the healthcare that we're delivering in rural communities. 77% of Wisconsin hospitals received either a 4- or 5-star quality rating from the Center on Medicaid and Medicare Services, which is a national quality ranking metric, and that was the 4th highest percentage of 5-star rated hospitals in any state. So rural Wisconsin hospitals are incredibly high quality institutions, which I think is always important to impress upon individuals who sometimes think that you have to travel to an urban area to get good care. And one other thing I wanted to highlight in the good section after hearing this morning's kind of forecast is that many of our hospitals are growing their mental health services as quickly as they can. And we know that farmer mental health is a really important topic in Wisconsin. We've seen some great collaborations between extension and CAP agencies and local farm bureaus and healthcare providers to help strengthen the network of providers that are available to care for farm families. So if that's a challenge you're facing, please seek out those resources in your community. But we do have a number of challenging things facing the healthcare field in Wisconsin when we look ahead to 2024. So we have workforce shortages now in our organizations, and we know that they are only getting more challenging as we look out to 2035 and beyond. And the difference between other fields and healthcare when we think about workforce shortages is it's coupled with increased demand, right? Because we're seeing these retirees aging out of the workforce, which means that they also are aging into higher utilization of healthcare services. So this coupled phenomenon of decreased supply of healthcare workers with increased demand for healthcare services is really challenging for rural hospitals to overcome. We're also seeing a number of cost challenges. So the cost of labor and the cost of supplies have increased dramatically for rural hospitals, over 10% since 2019. And we don't have the same ability to control the revenues coming into our organizations that many industries have. Specifically in rural healthcare, some of our hospitals have payer mixes that are 60% or more from Medicare and Medicaid. So those government payer sources don't necessarily keep up with inflation. And so that leads to an economic picture that's really tight for rural hospitals. And we know that we're seeing more hospitals operating with negative operating margins and a lot of financial pressures that are going to be crunching our field in the next year. So how are our hospitals thinking about improving rural livability? How does healthcare tie into this topic? What we know is that only 20% of health outcomes are attributed to clinical care. So while healthcare access is super important, it is a minority of what determines whether or not an individual is able to be healthy. A much larger share of people's health outcomes can be attributed to the community and where they live and the economic conditions within that community. So items like housing, transportation, education are really important to our hospitals because they know if those community conditions are not impacted, they are not able to improve health outcomes for the patients that they serve. So all of our hospitals provide clinical care. The vast majority of them help individuals who they serve meet health-related social needs. So this is things like when an individual comes in, they screen for food insecurity and help to refer them to a food pantry if that's a need an individual has, because we know that food access is linked with health outcomes. But our hospitals are also starting to think more upstream. So how can they address social determinants of health and change community conditions within their communities to lead to better health outcomes? And what this is really doing is taking the focus of healthcare off of the individual person and broadening it to think about the community and systemic conditions that are impacting health. Because we know that individuals' health does not exist within a vacuum, right? It exists within the frame of reference of their community and the systems that shape their community. So, why do our hospitals have this approach to their interactions with their community? The answer to that is because hospitals and communities are really inextricably connected. And if your hospital is struggling, oftentimes it indicates your community is struggling, and vice versa. If your community is struggling, it often indicates that your hospital is struggling. So, what the research tells us is that hospital closure occurs disproportionately in locations with higher socioeconomic disadvantage. And additionally, hospital closure is associated with areas of higher unemployment rates and higher uninsurance. So, if hospitals are in communities that have struggling economies, they're more likely to be impacted. And part of healthcare access and retaining healthcare access is ensuring that your community has a strong economy. On the flip side of this, hospitals are really positive economic drivers for rural communities. They're large employers. They have a number of economic spillover effects, including things that you wouldn't think of, like increasing local retail sales and increasing the number of small retail establishments within communities and the amount of sales tax that's generated within those communities. And on the flip side, when hospitals close, we see much broader economic effects than only the loss of the specific hospital jobs and the loss of healthcare access in the community. We see that closure impacting things such as construction, information, sales, and finance professions. So things that you don't traditionally associate with hospital closure. So one of the ways that our hospitals are thinking about how they can impact their rural communities that ties in very well with what Matt was talking about in terms of rural livability is acting as anchor institutions. And hospitals are definitely not the only anchor institution, but they're one of a number of anchor institutions in rural communities that have what's often referred to as sticky capital. So they can't just get up and move, right? The Memorial Hospital of Lafayette County in Darlington isn't going to say, you know what, times are tough here, we're going to Arizona. So they have a vested interest in making sure that their communities are thriving and that they're doing a business in a way that supports their communities thriving. Other anchor institutions that we often think of are schools, both K-12 and higher education, local governments, and sometimes churches and libraries too. So what is an anchor institution strategy? This is a way that our hospitals think about their role as anchor institutions in order to have a larger economic impact locally. That includes hiring, purchasing, investing, and my own bonus category of place-based investments when they're doing construction projects. So hiring often looks like grow your own strategies, right? What we know in rural healthcare is that we cannot rely on recruiting the healthcare professionals that are going to be the workforce of the future from outside of our community and winning them to come in. We have to think about creating our own talent pipelines locally for everything from CNAs up to physicians. And part of this also is thinking about childcare infrastructure within our communities, because we can have the best thought out workforce development plans. And if there is no one to care for children so that people can go to work, those workforce development strategies are not effective. Purchasing looks like supporting local businesses and local producers within your community whenever and however you're able. And rural communities, obviously in healthcare, you don't always have, for example, a glove manufacturer right next door, but you often do have farmers and food producers that you're able to support with local purchases, Main Street businesses, local contractors, and just thinking innovatively about how you're expending hospital resources to have a larger purchasing impact locally. One example, one of our hospitals did a purchasing scan and figured out they were buying all of their bread off of essentially the Cisco truck, and instead have now shifted that and are buying all of their bread from a Main Street bakery. So those little changes add up over time and help recirculate more money in the local economy. And finally, investing, right? So it's important for hospitals to have some sort of investment portfolio like most large institutions to ensure they can weather economic shocks, cybersecurity attacks, and other challenging times that come their way. But they can shift how they invest those investment portfolios to have a larger local economic impact. So we've seen hospitals support housing projects, workforce development projects, and overall relocalize some of their investment dollars to spur the local economy. And finally, we've had some hospitals think really innovatively about how their construction projects impact the local economy. So oftentimes when you're doing a big building project, it's much easier to buy potentially a piece of former farmland, go to the edge of town and have a blank canvas to build your space. And we've seen some hospitals take on some really tricky downtown development projects because they wanted to anchor that downtown. They wanted to drive foot traffic. They wanted to support other local businesses, and they wanted to help be a revitalization and spark of energy in their downtown. And I think that's an underutilized strategy, if you will, for some anchor institutions in rural communities. There are also some intangible roles of anchor institutions, right? So this is the stuff that you can't necessarily quantify, but has an impact on rural livability. So oftentimes our hospitals have the ability to act as a convener or a leader within their rural communities and pull people together to have hard conversations and solve issues and challenges that arise. One example, one of our hospitals was able to pull together a group of 20 different community leaders and business owners to go to their municipality and say, hey, we all know housing is a challenge here. What is our community's plan to deal with that? They were able to work with the municipality to get a housing study completed and work on recruiting developers because they acted as this convener around an issue. And while it sounds kind of squishy, I think it's a really important role for anchor institutions to play. We've also seen our hospitals advocate and educate on pressing issues within their community to leaders. Housing is a prime example of this. Workforce housing has become incredibly challenging in many of our communities, as Matt's slide showed, where you saw that huge share of homes owned by individuals that do not live in the communities. And by advocating to local leaders about the importance of workforce housing for the continuum of healthcare delivery in their communities, they've been able to shift policies and create positive change in the housing stock within their communities. And finally, leveraging existing non-financial assets. So we've had hospitals that have utilized their grant riders to partner with other local community organizations and take some of those soft skills that they have within their organization and bring in external resources to solve community problems. Hospitals have also done this with Broadband Task Force, using some of their IT knowledge to help drive county broadband planning efforts. And what this all really leads up to is capacity, right? We talk about this all the time in economic development. It's capacity for rural communities to tackle challenges that they have in front of them and find solutions that are grassroots, community driven, and fit their own communities. So what have we learned from some of this work in healthcare? It's that we do not believe in staying in your lane because the conditions of a community impact the hospital's ability to be financially solvent, to recruit staff, to continue to provide healthcare access, and to improve health outcomes of individuals within their communities. This is my contact information. I'm really happy to follow up with anyone. Thank you.
And we're back on time, just like that. Thanks, Marie. Up next, as we continue this rural livability conversation that's taken on a lot of different looks, Beth Haskovic. She is the director of Wisconsin's Office of Rural Prosperity, Wisconsin Economic Development Corporation. She's got a wealth of experience in Wisconsin Economic Development Corporation in place-based community development, capacity building, same phrases, commercial corridor developments, as well as small business capital and placemaking initiatives. The office is a one-stop shop for rural communities and advances rural Wisconsin through interagency collaboration and resource navigation. She's a hub. She's a hub for a lot of great things, a lot of great exchanges, information. I'm happy that we've had a chance to visit with this group before. Beth, come on up and share the insights on rural livability.
Great. Thank you, Pam. Good afternoon, everybody. I promise less graphs and charts and data. I love it, Matt. We use it a lot. That is not my wheelhouse. My wheelhouse is listening directly to rural communities and helping them navigate what resources are out there to help build some of that capacity that Marie talked about. So kind of repeating Pam's introduction, but we were created in 2020 by the governor's office to be a voice for rural communities at the state level. And so we were really given the task of being that one-stop shop, helping to navigate across other agencies on important issues, and really listening to rural communities and bringing that voice into the way that we design programs and projects. But also then taking all the information and the great work that's happening across state government and making sure that rural communities are aware of it, and there's that opportunity for them to actually access it. So that's our role. I have a team of 6 folks in my office. We're hiring now for a rural initiatives manager. If you know anybody good people know good people. But that's our role at WEDC, which is the state's economic development agency. And I'm going to talk a little bit today just about how we accomplish our work, as well as what resources WEDC has to offer rural communities, things we've heard and listened to through rural listening sessions across the state, as well as some of the other really timely and pertinent resources that I think might be good for this audience. So I'll jump right in. So how do we do what we do? I call our office kind of a startup within a larger organization. So we've been spending the last couple of years really defining what does the office do, how do we add value, both at the state level and at the local level, and with regional partners. So we kind of consider ourselves a rural thought leader, which means we want to partner with anybody and anybody who cares about rural communities and has a problem that they want to solve. We want to be part of the conversation. We want to help connect people to resources. And we want to tell you what we've learned through the creation of the Rural Voices Report, but also what we learned from other states or other partners and what's working well in other parts of the country, and how could we help bring that idea to Wisconsin and make it applicable to our communities here in the state. We also work, in addition to working with rural communities, we also work a lot with our tribal nations here in Wisconsin. We identify specific projects where we can utilize WDC investment to take a good idea that might be replicable and scalable and bring that to address some sort of systemic change across the state. We are a convener. Like Marie mentioned, a lot of our job is working just behind the scenes to get people together to help address some of those capacity challenges. And lastly, a big part of our job is resource sharing. So we have a website called ruralwi.com, where we have a whole body of different grant and technical assistance resources where people can come use our grant database and see what's out there that might have a resource that might solve for an issue that they have. So we are both looking for resource partners to help tell us, like, hey, we're not represented on your website. We want you to be included on our website. And we also want more rural communities to know about this resource because we're all busy. We all have a lot that we're doing. A lot of rural community members do their full-time job and then are volunteers in the evenings and weekends. And so if we can make it easier for people to understand what's out there, that's what we want to do. So last summer, we did some rural listening sessions across the state just to go out and hear what's working for you. We wanted to learn about how rural communities are accessing WDC programs, but then also how can the state better be a partner with rural communities? And what are some of the issues that you have that maybe there isn't a program for, just so we were aware of that. And so some observations from those sessions and some of the other work we've been doing. Small business really matters in rural communities. I think for a long time, when you think about economic development, there's this idea that you're trying to bring some big business to your community and create jobs, and the goal is always to create jobs. And jobs are important, don't get me wrong, but really small businesses in terms of recycling those dollars are even more important in rural communities. And beyond that, small businesses can really help a community shape their identity moving forward. Do they want to be an arts community? I think about Rhinelander and the Hodag and how you can go to 5 shops in Rhinelander and find different versions of the Hodag, and it's really been this kind of community identity that's people really rally around. So I think there's a lot of opportunity for small business, not just to generate local income that's recycled in the local economy, but also to create an identity for their community and a direction for where they want to go moving forward. Other examples, outdoor recreation is really important. The state has an Office of Outdoor Recreation. We just had a large conversation this morning of the number of businesses that are really concerned with the lack of snow and how it's impacting tourism, it's impacting, the hospitality business, it's impacting local shops. So how do we help communities find resources to when those kinds of situations happen? The second is that big word capacity that Marie mentioned as well. So as I mentioned, a lot of folks working in economic development in rural communities are usually volunteers or working part-time. They don't have the ability to spend a lot of time writing grants. So how do we help with grant writing? How do we help make sure that folks are aware of what's going on? Our team just launched a new program called Thrive Rural Wisconsin. We're in the community selection process for that right now, where we're going to be working one-on-one with 10 rural communities. We have 2 rural development specialists that will be partnered with those communities to help them with project management, move projects forward, help get quotes from consultants, things like that. Do a lot of that body of work that there really isn't time or capacity for a community to do so that they can move particular projects in their community forward. And then kind of building off a little bit of Matt's slides around those changes in population. We also hear a lot about climate migration and the concerns of rural communities that they maybe don't have the housing stock, which we've discussed already today, or some of the infrastructure to grow in a way that they're concerned about based on climate migration and those trends. So that's our office and some of the things we've been hearing about. I want to talk a little bit about Wisconsin economic development as well and make sure folks are aware of the resources that we have. We're housed in the Business and Community Development Department at WEDC. Mike Ward is our VP, but we have a number of different programs. We have community development programs, business development and attraction programs, as well as international business development programs. And we're broken into 9 different regions across the state with a regional economic development director that coordinates within each of those regions. So within our community development department, we have a number of different programs and services. A lot of folks may be familiar with our Main Street program. Erin Welty and her team are fantastic. We have brownfields grant programs, capacity building grants, Fab Labs, which are is a program for high schools to basically create maker spaces within their high school that help with like pre-manufacturing skills and things like that. Idle sites redevelopment and diverse business development, as well as historic tax credits. Now, when we went out to talk to rural communities about all these programs and about what WEDC does, the one program that we heard a lot about was our community development investment grants. That program is really accessible for rural communities and probably the one program in this department that folks were most aware of. So that program can help with commercial real estate development. It's a $250,000 grant for commercial real estate. This is an example of one of the projects that we funded through this grant program. We also do a number of grants around helping small business providers create new programs to support entrepreneurship in their communities. That's through our E&I team, and so we have business development and attraction. We have our entrepreneurial partnership grant, and one of my goals is to create a larger pipeline of communities, rural communities applying to this program. So county economic development folks, regional economic development folks that are really creating new programs that help support entrepreneurship in rural communities. Size Up Wisconsin is also a great tool. It's a data tool that helps communities or small businesses in particular have a better sense of what the market is in their area. and get some of the data that larger businesses often use for site selection or other business growth strategies that a smaller business wouldn't typically have access to on their own. Our office also facilitates cooperative development grants. So in our previous iteration, that was used just for feasibility studies, but we can actually use those now for the development of new cooperatives across the state. And of course, we work through partnerships a lot, so I had to give a plug for the Cooperative Center at UW. They provide a lot of technical assistance and help create that pipeline of grant programs, of grantees, excuse me. Another thing that our office does is really take really complex resources and try to make them easier for folks to navigate. And so we created a website on a web page on our website dedicated to the bipartisan infrastructure law. So this has direct links to all of the other state agencies and what their bill programs are. There's both formula funding, which means it's funding going to a program that already existed at the state level. And then there's competitive grant funding through that program as well. We have a list of consultants and grant writers who can help support communities in applying for some of that funding, and a downloadable spreadsheet of what the most recent or open opportunities are with that funding. The Inflation Reduction Act is also a really timely resource to be aware of. Our partners at USDA are receiving a lot of funding for soil conservation, as well as some energy solutions. One program that I think, oh, it's not advancing. Oops, sorry. One renewable energy program that I thought was really interesting was the direct pay tax credit, which like a private business would always be eligible for getting the tax benefit of creating renewable infrastructure, but this allows nonprofits and city or municipal governments to benefit from the tax benefit of renewable energy as well. And then, as I mentioned, one of the trends that we're working through is around rural entrepreneurship. So I know Maggie's here from UW Extension. She's focused a lot on developing more programs for rural entrepreneurs throughout the state. WDC received $1 million from the Department of Administration to fund this program, and really expanding the resources that the UW Extension offer, as well as the Law and Entrepreneurship Clinic to rural entrepreneurs. We also work a lot with USDA and their business and cooperative programs to help bolster rural entrepreneurship across the state. So a lot of what we do is just celebrating what other people in the state are doing and making sure that folks are aware of the resources. So I just want to highlight a few resources that I thought were pertinent to this audience today. DACAP is in the room, but we've been working a lot with their office to promote the Resilient Food Systems Program, RFSI, that has an open grant opportunity right now for kind of middle of the food chain food processing grants, both for equipment grants and infrastructure grants. Obviously, you can go to their website, rfsi.wi.gov, to learn more. We've heard a lot about agritourism and the need to help farmers diversify income. So we've met with WADA. We've looked at some of the national resources that USDA offers, as well as the National Agricultural Law Center. I learned today that the UW Extension folks are putting together a cohort for agritourism, which is amazing. Just thinking about how do we connect farms directly to consumers? How do we help create local entertainment and event venues which solve for other rural livability issues? How do we help provide lodging opportunities for rural communities to bolster tourism and bringing farm revenue to farmers at the same time? And generally, how do we celebrate the rural culture and places that we have throughout the state? So a couple of examples of, I've had the opportunity to travel around the state quite a bit. So a couple of my favorite examples of agritourism And this is something we want to celebrate a little bit more on our Rural Wisconsin website. We celebrate successes of things that are working well in rural communities throughout the state. And so I'm always looking for more agritourism examples to add to our website. But the Red Clover Ranch in Soldiers Grove provides farm-to-table dinners, has little cabins that you can rent out for lodging, has a pottery studio. So they're bringing a lot of different cultural amenities to their farm or to their ranch for income generation, but they're also providing those services for the local community as well. And as part of that kind of placemaking and agritourism work, there's a great resource through USDA called the Rural Placemaking Toolkit, which is a great resource just for being more aware of how do you help build some of this placemaking and this place-based tourism strategies and business development strategies that highlight arts and culture of the area. So just wanted to highlight that resource. A great example and a kind of a nationally recognized example here in Wisconsin is the Worm Farm Institute in Reedsburg. Our office sponsors their farm detour every other fall. They have their own method of creative placemaking, which often is thought about only in a downtown context of driving traffic to a downtown, but really can be a regional strategy. And what I love about Worm Farm is they really partner with the farms in their area to be part of the planning process and to engage in placemaking with them. And they do site-specific installations on farms throughout Sauk County. And with that, I'll leave my contact information, and I think we're ready for our conversation. Yeah.
Great, Alice, let's go. So stop and think about the communities maybe you grew up in, you traveled through, and some of the comments that our panel is shared with you. And again, remember, if you've got questions or input, what have you, there's microphones right there. I'm going to talk about one that I think is kind of the elephant in the room, connectivity. I know all three of you kind of alluded to it in different parts of your graph, but forgive me, as a farm broadcaster, it is in our face all the time how much our rural audience, and they don't have to be farmers, I'd like to think I can kind of appeal to almost anybody, our rural communities have zip for connectivity, unless they go to the public library, school, McDonald's. And that's not just the wire, that's the cell phone too. And every time, and I can hear this, I was berated by a sweet little old lady that said, every time I see you on TV, you've got a website. All the information I need is on a website. I have no internet. So what is that as far as an element for each of your quests? And where are we at? Because God knows every other story we talk about is how much money the government's throwing at it. And that's been for how long? Tell me, give me an update. What say you about connectivity helping you accomplish everything you're after?
I'll go ahead and start. Broadband is an issue that we're working on a lot with a lot of communities around the state of Wisconsin. It's a bit of a slow process, unfortunately. But if anything good came out of the pandemic, it did make communities realize how important broadband is for healthcare, for talent attraction retention, for quality of life, for education, and all these other factors that make a community livable. And there is money coming. We are getting $1.1 billion for broadband expansion in the state of Wisconsin. Most of that will be targeted towards 100, 200 speeds, so above and beyond the traditional definition of broadband. And we'll also prioritize fiber rather than fixed wireless when possible. So it's not coming as fast as we want it to, but it is coming, and we do recognize, I think even more so, how important it is for our rural communities.
Yeah, I think just to tack onto that too, what we know about how the federal investments are coming to our state is through this BEAD planning process, which is much more comprehensive than our prior kind of methods of broadband expansion funding, which were basically the communities that had the capacity to do the research, figure out where the grants or where the gaps were in service, find a partner, write a grant, et cetera, were the communities that got funded. Whereas the BEAD process is a little bit more equitable because it has some planning dollars associated with it, and all communities are required to be part of like a BEAD planning unit, whether it be at the county level or the regional level. So we know that rural communities that maybe were not previously able to access some broadband resources will hopefully have a better shot through the bipartisan infrastructure law. The other thing I just want to highlight though is we always talk about access and we never talk about affordability and digital literacy, and those are super important from a healthcare perspective because the cost of broadband is still challenging for some individuals, and even if they have service, do they know how to utilize all the digital tools that are available to us, especially when we think about telehealth, remote monitoring, scheduling visits online, all of these things that where healthcare and broadband interact. That digital literacy piece is super important, and utilizing libraries and community centers and other kind of anchor institutions to help connect individuals with broadband tools is going to be really critical.
I don't have a ton to add to that because they covered the main points, but I'll say I do know that a lot of the locations that'll be eligible for BEAD funding have been kind of put into a state plan, and there's currently a challenge process that's underway. UW Extension's been helping to educate communities about that challenge process. There are a few steps communities have to go through to be able to participate in that challenge process. So use Extension as a resource to learn more about how to do that, because all of those locations then by May will be kind of outlined, and that's what a lot of the grant funding that will be coming through will be utilizing. So just taking that opportunity to be proactive and engage in some of that data now can help in a few months when those grants open up.
Paul?
I have a question for you, and I learned a lot about some of the things like what I don't know how to say it,
EDC.
WEDC, I gotta say it, or in the rural health cooperatives. And what I'm kind of looking for is like, what are the biggest challenges? Like, is it a lack of awareness of these kind of programs or the activities they do? Is it a lack of interest by the rural communities? Or are we doing all right? Or what's our biggest impediments to making rural Wisconsin more livable? Is it something that's outside of our control, like large economic forces that we can't control, social trends, or is it something we can do about it? I'm just kind of curious what your experience is trying to tell you. What are the biggest challenges that are preventing us from improving rural livability?
Yeah, I mean, I would say it's probably a combination of both. I think it's systemic challenges, and then I think it's awareness and that ability to actually navigate some of the programs that are out there. And so I think there's a lot more that can be done to make both state and federal resources more accessible to rural communities. I think typically they're designed for problems of scale, and you have a scale issue at the rural level because you have less population. And so it really is being creative about how to work collaboratively or create regional approaches to some of these solutions. So I think that's one thing that I think we can work more towards. I think making things as easy as possible is something we heard a lot in our rural listening sessions, like breaking down everything you're going to need to be able to apply for a grant on the front end so people know what they're getting into. Because I think what you'll find a lot of times is people aren't aware when they're first applying for the grant what the reporting requirements are, and they might get the grant and then be like, we don't have the capacity to manage this. And then it stops that particular project or initiative from moving forward. So the more that we can help be proactive in breaking down programs, helping explain them, being sure people are really aware what they're getting into. Again, it's not a lack of talent or willingness at the local level. It's just a lack of having a full-time staff member that larger cities or municipalities have that's focused on just doing that. So how do we help break that down into actionable steps where people can really access what's available to them?
Yeah, I have a couple comments on this. The first probably comes from the fact I'm an optimist, but I grew up in Georgia, and then I moved to Wisconsin as an adult, and so I always kind of juxtapose the two regions of the country. And I think that rural Wisconsin has so many assets to build upon that give me a lot of hope for the future of rural communities. But I think one of the challenges, right, is the phrase that if you've seen one rural community, you've seen one rural community, and all of their challenges are unique. There's not like these cookie cutter solutions that fix everything. And just to play devil's advocate, as wonderful as state and federal resources are, they haven't figured out how to solve everything. I think specifically about the childcare challenge that we see in a lot of our rural communities. Each community is really having to craft pretty specific local solutions to help with the sustainability of that really critical piece of infrastructure in rural communities. So there's still, like Beth was mentioning, is a lot of really localized work that has to occur. And communities have to have the capacity to do that work and solve challenges that exist in their communities.
Yeah, and certainly there are structural issues that rural Wisconsin faces and other rural Wisconsin or rural communities throughout the United States face as well. So we can't just ignore that there are some underlying factors that we're facing and when it comes to rural livability. But I do want to build on one of the things that Beth said, and I do think regional cooperation is an area where we've made a lot of progress over the last couple of decades, but it's one where I think we can continue to grow because it does go back to capacity. If every community is against every other community, we just don't have the resources and the abilities to build everyone up at the same time. That's great that your football team is a rival of the neighbor community over there. Keep that up. But at the same time, find ways to work together because you face similar issues, you face similar economic opportunities, and you often share a labor market.
That's hard. That's hard, though. Go ahead.
Yeah, my name is Jeff Hadacek, and I'm a new assistant professor and extension specialist in the Department of Ag and Applied Economics. Beth, you talked about sort of the funding that's available for renewable energy transition in a lot of rural areas. But I think if you talk to folks that live in these rural areas, that may be sometimes a disamenity to live there as well, which kind of stands in contrast to what you were talking about, Matt. So I am curious if you talk to that tension a little bit, how you're preparing sort of communities for additional rural renewable energy opportunities that are oftentimes being implemented on agricultural lands.
I can start. So a few of the projects we've worked on actually haven't engaged farmland. They've been more about cost savings at the municipal or county level. So making sure to transition municipal or county buildings or village buildings with solar or other energy saving technology. We were looking at one project in Bayfield County to transition snowplows into electric vehicles, and the cost savings that would allow them to hire additional staff to manage all of the engineering considerations of doing that. So I think that's what we've seen through our office is really thinking about it through the economic standpoint of transitioning to renewable energy and how that can benefit the bottom line of the local government.
I would basically just say ditto to that response. We have a number of hospitals that have been quite forward-thinking when it comes to new renewable energy adoption. Specifically, Gunderson Health System was the first health system in the nation that produces as much energy as they consume as a health system, which is a unique fact. And we've seen it with our independent hospitals too, in terms of solar and adoption of other renewable energy technologies. And for them, it again comes back to financial sustainability. When they can drive down those operating costs, it makes them more sustainable over the long term as a rural healthcare organization. But I'd also say, just like as a rural resident, I think that the land use question you brought up is something that our state does not have a comprehensive answer to, and that we need to do more forward-thinking planning and community engagement around, because I think that many of our responses at the local level when debates around land use between agriculture and renewable energy come up are more reactive than proactive, and that's an area where our rural communities could grow.
And this is an area I have a lot of direct expertise in, but I do know one of our state specialists, Sherry Gruder, is active in this area, working with communities to think about strategies related to things like how do you put EV chargers in tourist communities to help attract people that may be driving electric vehicles to those areas and make them know that they can get a reliable charge. We also have a number of our county extension educators that are working with some of those issues related to land use in terms of things like solar field development, land use change, and having those community conversations with the parties involved.
Could I ask you to comment on the housing challenge? Because we've been fortunate to share stories about rural communities that got creative primarily for labor force for local dairies. Then we found out about other stories where it's kind of like that, not in my backyard. How do you try to help bridge those conversations? Because whether you like it or not, as an old broad that grew up in rural Wisconsin, there are still stigmas that you've got to work around regardless of grant monies, regardless of, available resources and things like that. And housing might be one of those. Just wondered what your experiences have been, maybe a positive and maybe one where it stubbed its toe or something like that.
Yeah, I can give some positive stories. One example that's been very positive is Door County Medical Center. They have been really outspoken advocates for the need for workforce housing in a very tourism-driven community that's seen significant increases in home prices since the pandemic. And really the position they have taken is one of education. They've been able to share stories where they've had inpatient nurses living in the back of yoga studios, x-ray techs living in sheds, and been able to paint the picture that if individuals in their community value continued access to healthcare services locally, those people need somewhere to live. And that helps to battle some of the stigma you're talking about when individuals say, I don't want, these people not in my backyard. When you can personify that individual as the person that helps grandma when she falls and breaks her leg, I think it starts to change community conversations.
Absolutely. I mean, I think education is a huge part of it. We're also seeing, in addition to the healthcare industry, we're seeing manufacturing and hospitality establishments across the state either become directly or indirectly involved with creating workforce housing. And I think part of that is helping the community understand why we need this type of housing in our community and why it will benefit the community going forward. There's certainly stigma there. I don't think that's just restricted to rural areas. I think that happens when you talk about workforce housing in almost any community in rural and urban areas alike. But I think we are making progress. This is a topic that I don't go into a single community and not hear about. And I think it is something that is increasingly going to receive the attention it needs to and find the solutions going forward that we need.
Interesting.
Yeah, I would echo that. We've heard the same, the workforce challenges related to housing are huge in rural communities and tribal communities throughout the state. I believe the most recent statistic was 140,000 units that Wisconsin is short on housing. So it is a huge challenge, and one of the biggest barriers, I think, to job creation and economic growth. We just, on a call this morning, we were discussing a recent grant that WDC did in Ladysmith, transitioning a vacant school building into housing. And I think there's a lot of opportunity there with looking at, some of those municipal buildings or school buildings that are no longer being occupied. How do we bring those sites back to active use and use them to solve for a major issue in the community as well?
Can I add one more thing? I think oftentimes one area we have to make progress is that in rural communities, density is a dirty word, and really density helps farmland preservation, right? When we're able to have more individuals living in spaces that are already developed. And I think that is also an area of opportunity for the ag community and rural economic development folks to work together.
Very good. One more.
Since this is an Outlook forum, I was curious for your outlook on the rural Wisconsin economy, or what areas do you see most promise or progress, and what areas are facing most difficulty, be sector or geography?
Didn't Steve cover that this morning?
Anecdotes are fine too.
It's just one I'd mentioned before, and I do see a lot of progress coming with broadband. I think that's a real area of growth. There are some challenges, no doubt about it, with it, especially related to things like workforce. So as we're trying to build this infrastructure, we simply just don't have the workers that have the skills to put the fiber in the ground or build the towers. So that's still a challenge going forward, but I am very optimistic that we will have universal coverage in the state in the next 5 to 10 years.
One of the challenges I see, which Matt alluded to in his presentation, are the kind of differences between communities that are potentially high amenity, high natural resource, or urban adjacent with a high quality of life that are able as rural communities to really tackle challenges and grow, whereas we have some other rural communities that are struggling with some of those shrinking and aging demographics that maybe don't have as much capacity to tackle the challenges they see. And I personally would be concerned about kind of deepening inequities between those two rural communities. One area of opportunity or promise that I see is a lot of our rural communities are thinking differently about the demographics of the future and realizing that welcoming immigrants and newcomers is part of a really vital economic revitalization strategy for their community, and being more strategic about what welcoming looks like in their communities. And I find that really exciting and promising and hopeful.
I think going back to my presentation, I think one of the most exciting things that I see is the way that communities are addressing placemaking and really thinking about their local identity and where, like, instead of looking backwards on who they used to be as a community, looking forward and looking for resources through extension and other regional partners that can help them do that planning to know, like, this is what we want to be known for in 5 years or 10 years. And I think creating those unique identities not only supports the economy, but also just builds that community pride and that sense of connectivity, not only through broadband, but just the social networks and the support networks that exist within a community. And I think rural communities do that well already, but it's not often formalized or bragged about or talked about as much as it could be. And I think there's all of the pieces are there. It's just about elevating them and really, proudly sharing that's the brand that they want to have moving forward. That's what they want to be known for.
Very good. Very good dialogue. Matt, Marie, Beth, thank you very much. They will be around. We'll take our quick break. Back for the final phase of rural livability at 2:40. Again, they'll be around if you want to follow up on questions. All right. One more time, let's cease the conversations and have a seat so that we can finish up our last phase of conversations about rural livability. In case you've not been informed, our final speaker, Eric Richardson, has been unable to join us today, so 2 more speakers to go before we can adjourn for more conversations. And our reception, thank you very much for your attention, everybody. Great conversations, a lot of different angles of conversation. And let's resume. So if we can quiet our conversations or take them outside. Next up, I want to welcome to the podium Samantha Evans. She's a community development advisor for the Federal Reserve Bank of St. Louis. Gentlemen, that's you. In her role, Samantha fosters collaboration and conducts research and analysis on a variety of topics that pertain directly to the workforce development and job quality. Right now, she serves on the Arkansas Community Development Society Board of Directors, also sits on the University of Central Arkansas's Community Development Institute's Advisory Board. From Arkansas, we welcome in to our wonderful Wisconsin world, Samantha Evans. Yay. Welcome. Thank you.
Well, thank you so much. I've just really enjoyed my time here so far. It's just been, I've learned so much. And I'm not gonna lie, I was definitely one of those people who was Googling whenever you guys were talking about the hodag. And am I even pronouncing that correctly? My southern accent may be getting in the way, but thank you all so much. Thank you all who are here in the room and online that's braving the elements here. I'm just really going to be really brief and kind of talk a little bit about kind of how the Federal Reserve kind of approaches this conversation around rural and economic development. But before I begin, I really am grateful to Paul Mitchell for the invitation and opportunity to present rural development resources from the Federal Reserve. Which is an area that's really near and dear to my heart. Having grown up in a small town in Arkansas, I have an affinity for the people and places that make up rural America. I'm one of those girls who, whenever going to high school, after I graduated, I hightailed it out of there. And I was like, I'm never returning back to my small little rural community. I'll see you all later. But as I thought about wanting to grow a family and where I wanted my family to live, it really is a place where I thought about wanting to return. And so really being able to do that work at the Fed and really understand that has just been really a big part of the work that I've been able to enjoy. Let me see if I can find the clicker. Okay. So if you have seen anyone from the Federal Reserve speak before, you have seen this disclaimer. So before I get into an overview about our work and how we utilize our rural framework, the information, analysis, and conclusions set forth are my own and do not necessarily indicate concurrence by the Federal Reserve Bank of St. Louis, the Federal Reserve Board of Governors, or the Federal Reserve System. So mention or display of a trademark or anything like that do not constitute an endorsement or criticism by the Federal Reserve System and does not imply approval to the exclusion of other suitable products or services. So if there's anything good that you hear, well, that's me. I'm taking credit. And if there's anything that you hear was like, oh, I don't know about that, well, ask my colleague David here with the Chicago Fed, and he'll be able to set you back on the right track. But really, so the Federal Reserve, if you're not already familiar with our work, we are the central bank of the United States. We have responsibility for monetary policy, which you can think about as maintaining full employment or maximum employment in the United States, as well as maintaining stable prices. So happy that Steve was able to outline a good bit of that economic data earlier today. I am not an economist, so you will not be seeing any of that. I may have 1 or 2 graphs just because, But really here, I'm just kind of tell a little bit of a few stories. And we also are responsible for supervision and regulation of banks and payment systems. So you are really trying to make sure or ensure in a couple of ways that the money that is kept in banks, that they remain secure, and that also that banks are being responsive to consumers. So by ensuring there's fair access to credit, that banks are meeting their obligations on the Community Reinvestment Act, which is essentially asking them to invest in or lend to or provide services back into the community at a proportionate rate that they're receiving deposits from their community. And many people are unaware or may not realize one of our other main functions is around community development, which is we're working really hard to really be able to think about and promote economic resiliency and mobility for low and moderate income communities and underserved individuals and communities. So in a way, we really think about that is around the economic growth. So we know that economic growth doesn't always happen proportionately in every neighborhood or in every region or even in every household. And just because the economy may be booming in one area, it doesn't mean that it's that everyone is able to experience that boom. And so we're really looking at what are the drivers or opportunity that might be able to help communities look into or maybe investigate or pursue that really could help economic resilience and mobility for individuals and families. And so why rural development is important to the Fed, we know how critical rural communities are to the economy, hence why we're all here today. And it's been really demonstrated really greatly already throughout some of these economic updates and through the panel earlier. And so we know that's an integral part of our national economy, that our national security, as well as our identity. And so a large share of the land area is considered rural, and that around, depending on your definition, around 45 million people, or at least 14% of the US population, considers rural home. And furthermore, without the critical contributions of our rural communities, many aspects of even suburban and urban communities and economies would not be possible. And so we know that having and being able to understand those incentives and developing a better understanding of how we create a better opportunity for rural households, businesses, and communities can be even illustrated in a recent publication, multimedia publication that we recently published through Fed Communities, through our Fed Communities website. And so when we even think about the economies of rural and urban regions, we know that whenever they're integrated really well, that they both can be able to perform better. And even whenever one only functions well on its own. So as a nation, it's really important that we recognize how both economies are linked to each other's success and the overall economy. And from careful review of previous and current research and meeting with rural stakeholders and practitioners, we have to understand that rural communities are more likely to be successful in fostering broad-based economic prosperity if they take an asset-based, equitable approach to their development activities, which we heard from our panelists earlier, in which that has been taking place here in Wisconsin. And so we call it the trick. It's really a nice little acronym to kind of sum up how we think about that framework. And so back in 2021, we published Investing in Rural Prosperity, looking at this framework, which really works to inform our rural development stakeholders how policies, as well as practices and funding streams at the local, state, and federal level can help support the achievement of shared economic prosperity. And so we wanted to not only do that by looking at these practices as well as funding streams, but also be able to have a place where success is happening, right? So we talked a little bit about where those successes are seeing, where we're seeing those successes happen. And so we put together a series, not only within the book, you'll find several case studies within there too to show and highlight where success is happening. And being able to do that in a way where we're able to celebrate what's worked in our rural areas. And so the book is kind of really organized around this framework you see from my colleagues Andrew DeMont at the Federal Reserve Board, as well as Daniel Davis with the St. Louis Fed, where they proposed this framework. And so we believe that while every community may have assets to build on, we're aware that simply having those assets is just not enough or sufficient condition for shared economic prosperity. It really takes what we were seeing, what Beth was talking about with your work, being able to coordinate that, being able to convene and convert those presence of those assets into economic prosperity that is felt by the whole community. And so to do that important work, we really look at focus specifically on rural communities. While it really focuses on rural communities, we also believe that this approach is applicable to folks who are here in Madison or even in our suburban context as well. And so really thinking about it being collaborative, you see the rings kind of intersect as well. And so collaborative and tailored. Rural development is truly tailored when the needs and opportunities of the community are identified through a collaborative process. And so to be effective as possible, partners in collaboration need to be tailored to the specific community context. And so what I'm hearing from a lot of rural communities within just my area is that we can't copy and paste what has worked in one community and set those same conditions and being able to have a program and copy and paste and think it'll happen into another community, right? We already heard from our other Maria and talking about how they work and how you have to really be having that to be tailored. We also have to have collaborative and inclusive processes. So true inclusion is collaborative, and that involves inviting all groups to the table. Even my curmudgeon of an uncle who may not want to be involved and thinks nothing good is going to happen here, I still got to invite him to the table, right? He still has to be a part of that process. And so really looking at ways to listen to their perspectives and incorporating their ideas. So the best collaborations, right, are inclusive and they create shared leadership and power. So we can't just do it in a way where there's a tokenism behind it, that, hey, we wanted to check mark these people off the list to say that they're involved. It has to be a part more inclusive to where there's power shared and being put at the table. It also has to be collaborative and resilient. And so to truly be resilient, a rural development plan must be developed through, collaboration is I think the key and the theme here, and that is carried forward, and that those are intentionally considered how to keep the partners together over time, right? So we come together, we have a planning grant to being able to do these dollars, to being able to understand what we need to do. You put together a plan, a report. It may sit on a table, it may not, but in order for it to be truly resilient, we try to talk through the book and show and highlight case studies where communities are actually saying, no, we don't want that strategic process to sit on the table. We actually need to continue to keep leaders engaged. And so what is a process that we need to develop in our community to ensure that all people are engaged and they're engaged over time? It also has to be tailored as well as inclusive and resilient. So resilience necessitates being inclusive so that future community leaders help develop the plan as a result and are committed to it. Furthermore, rural communities cannot be resilient if their most vulnerable residents remain at risk, right? So if you're saying, okay, the same 10 people, right? Some of our communities I've worked with in the past have the STP problem, right? The same 10 people. And so whenever that happens, it's great because you have the leadership, you know who's being a part of that process. But what happens over time is that those that were not included may not say, well, our community, nothing's changing. It's always the same people. I don't see any progress that's happened because they weren't originally included in the process in the beginning. And so how can you be able to create a way where it's both inclusive as well as resilient? So all people say, no, no, no. You were at this meeting at this time, you were part of this event, and you continuously keeping them engaged in the way in which they want to see themselves engaged. And so again, we have this publication. It's a free publication. I'll provide a link to where you can be able to download that, not just that, but other resources. But it's over 600 pages long. In the true Fed fashion, we converted over like 80 authors and brought all their great and brightest. But for those of you here and online, I've been able to look through it, and we come away with a few key takeaways to really kind of look through where we're seeing some change happening and some of the big takeaways. So in that, and we so glad for your work, Bat. You kind of already discussed this around some of the demographic changes that's happening in rural communities. And so population declines in some rural areas, gain in others, resulting in virtually no net growth in rural areas overall over the last decade. Yet America's rural and small towns have experienced substantial racial and ethnic changes since 1990. as highlighted in one of our chapters by Kenneth Johnson and Dan Lichter. And so they really look at analyzing the Hispanic population in areas that have experienced chronic outmigration. And so looking here at 2019, we see that 78% of the non-metro population was identified as non-Hispanic, while between 1990 and 2019, the non-metro Hispanic population nearly doubled in size. And so not only is this an area that we're seeing overall in the US, but also in the Great Lakes region. I know that the Urban Institute has already also looked at some of the Great Lakes demographic changes that are happening and what's being done there. Second is that local rural capacity requires community-based organizations. And community-based organizations we know are something that's required that has to be local, right? That has to be members within the community being a part of that process. And that's where you're gonna see real capacity. Because a lot of times we talk a lot about capacity, but sometimes it's really a bandwidth, right? A level of resources, being able to take on that. Like while you have a mayor that may be dealing with roads and sewers and water quality and challenges there, you also need to have community-based organizations that are a part of that to being able to really think through some of these areas. And so in one of the chapter, they kind of outline some 6 ways to kind of build that. So looking at organizational capacity, a lot of times those community-based organizations are going to be folks who are from that community, who know the players, who can walk up to somebody's doorstep and say, hey, I need this person to be a part of this conversation, how to be able to know what levers to pull and what levers to meet, to being able to meet whether you have a state or local or federal opportunity coming into that community. So rural entrepreneurship, we know that rural counties have a higher rate of self-employed business proprietors in metro areas. So this is an area to celebrate, right? While rural entrepreneurship or this is really Tessa's lane, really, and somebody that I go to just to understand and hear what's happening there. We know that these entrepreneurs hire others in their community, they create new jobs, and this constant churn of pursuing new ideas and opportunities really creates community vibrancy. And so really not just vibrancy, but that livability. I think you talked a little bit too about that, Matt, around what's happening in this space as well. Next is a significant factor in the difference between recovery and resiliency is the leadership in place to support a community's transformation from its past to its future. And so a lot of times whenever I'm going out talking with communities, a lot of times they'll say, well, what is your biggest asset in your community, right? And they always say the people. And it really takes leadership within that community. So you'll have communities not only looking at leadership there, but then also thinking about the future leadership. So building out these youth leadership programs to being able to be good stewards of the resources that are in their communities and what that takes. And like, again, I said, like mayors and your local officials, they have a myriad of issues and challenges. But really having and creating that professional staff is of critical need in a lot of our small rural communities. Someone who's waking up every day and their main focus is really thinking about the economic growth or resiliency of their community. And so what are some ways in which they can be thinking about that, fostering that? How can they engage others and other organizations within that process? And not just thinking about state and federal local dollars or even that, but like how you laid out the capital frameworks, there's other ways to where we need to think about and broaden the conversation around investment. And so that really brings me to rural communities. Yeah, our people are our greatest assets, but we also need access to capital to thrive. And capital, financial capital, we need cold, hard cash. But a lot of times we were just talking, right? That cash is not always the challenge. It's not always the issue. And so what are the ways in which we can be able to kind of think about that and identify that and think about the gaps? Because it not only looks at what a community is able to do, but it also leads to having not access to a lot of this, also leads to, like what Marie is talking about, those social determinants of health and chronic issues and health issues as well. So what are some ways that we can kind of think about that per capita with engaging philanthropies and others within these areas to kind of increase access to capital in our rural communities? It's also a big takeaway from this publication that we have. And so I definitely encourage you to download the book. Like I said, it's not just this book there, but we also have other resources. We have webinars, We also have expertise in analysis where you can engage and talk directly with those leaders. Please reach out to me. I'm easy to find online. If there's somebody in which you want to connect with, I'll be here all day as well. So feel free to come and say hello, and as we grab a glass of wine, or I hear Wisconsin has really great beer, so looking forward to that as well.
Yeah, 600 pages. I'll take your cliff notes. Very good. Appreciate that. All right, let's keep rolling here and keep that momentum going. Coming up next is the Director of Research, Knowledge, and Evaluation for the Center on Rural Innovation. Her name, Dr. Amanda Weinstein. She leads the Research, Knowledge, and Evaluation team in providing a better understanding of the economic dynamics of rural America and evaluating our programs guiding communities toward tech-driven prosperity using rigorous analysis and real-world insights. Amanda, come on up. You are our crescendo for the day, and we welcome you.
Thank you. I really appreciate being here today. I know I am all that stands between you and this great Wisconsin beer that I am hearing about. So I'm going to try and make this fun, even though, yes, I'm an economist. I do love graphs and charts. There'll be some, but it'll be fun. So this is research I started back even before I was at the Center on Rural Innovation, really dealing with this idea of quality of life and how does this big idea of kind of livability or quality of life affect small towns in rural areas. So as she said, I'm Amanda Weinstein. So we do a lot of research dealing broadly with what's going on in rural communities and how we can help these rural communities. So this is kind of one graphic we have of our economic model at the Center on Rural Innovation. And over on the left, I know it's a little hard to see, but these foundational elements. To me, I think of these foundational elements as quality of life, right? They build a strong foundation to build on top of that. And specifically what we're helping communities to build on top of that is their tech ecosystem. And we've heard a little bit today, things like broadband, right? Once we have that strong quality of life foundation, we need those capital investments. We need things like broadband, like workforce training to then get that tech ecosystem. So we're really gonna spend today on the left-hand side on that quality of life aspect. So at the Center on Rural Innovation, our organization started because we saw this growing divide between rural and urban areas. And we see it in the news all the time. We hear about hospital closures, we hear about these divides. I pulled one article here where, yes, rural areas are saying like, hey, we need some broadband, right? We see this divide and we wanted to address it, right? You can see this divide in the data. Matt did a nice job of showing this, right? When you look between 1950 onward at population growth in urban versus rural, right, you see that gap widening, right? And there are some big economic trends of why. We know that globalization, automation, the decline in entrepreneurship, and the rise of the knowledge economy have all contributed to this widening gap between rural and urban places. So this is work I should say I've done with a number of co-authors. Amongst them, I have co-authors at Ball State University in Muncie, Indiana. So they are very familiar with the Ball Corporation. So the Ball Corporation actually moved to Muncie from New York. So they moved to this small rural town. And one of the Ball brothers wrote kind of a memoir of kind of why did he move to Muncie? Why did he move to this rural town? And he basically says, it's not because Muncie was nice, right? It's not why we went. Nobody thought Muncie was a nice place to live. We went there because people were kind of business-like, right? And it had good workforce. We had some natural gas. It had a rail line. That's why we went to Muncie. Fast forward 111 years later, Ball Corporation moved out of Muncie, where they had been for over a century, right? Where did they move to? Outside Boulder, Colorado. Arguably, compared to Muncie, not arguably, more expensive on basically every business metric you can come up with. Real estate, what you have to pay people, everything is more expensive. What are they doing as a business, right? Why are they moving to Boulder? Why? They had started a new aerospace sector. And that's where they had to go to attract people. They said they couldn't attract people to Muncie anymore. They had to move to Boulder. So I was telling this to my class and my students, and there was one student in particular who was really nodding. And I was like, okay, there's no way anything I'm saying is that interesting. What do you know that you're not yet saying? And she said, oh, my boyfriend has an internship with Ball, and I think we're gonna be moving to Colorado in the summer when we graduate. And I thought about what that conversation might look like with their families, both from Ohio. And I thought about them saying, well, we're moving to Colorado because that's where the jobs are. But we tend to let the conversation stop there. And we tend not to ask, well, why is the job there? Why is the job in Colorado? Right? So it's really this very muddled, messy conversation I know Matt brought up too of, is it people following jobs or jobs following people? It's probably a little bit of both, and it's probably also changed over time. So one thing we wanted to look at is which one is kind of happening more now, right? When we look at Ball Corporation, that's people, that's that job following people, where people want to be because it has a higher quality of life. So we know that there are rural areas that are struggling. We can see this in the data. We can see a lot of rural areas are struggling. But there's also some rural areas that are doing very well. We can look to those rural areas to say, what are they doing? What are they doing that's working for them? And part of it comes to how we define that rural area, right? So that graph I showed you on the right of looking at population growth over time, that's rural areas defined today. But there's a lot of rural areas that in 1950, right, are missing in that picture. So in 1950, we have more rural areas that have since been classified as urban. That tells a very different story on the left than the right, right? The one on the right says, oh, rural, you're not doing well. Maybe urban can teach you something. The one on the left kind of says a different story. Oh, urban, looks like you're not doing as well as rural here. What can you look to rural areas to teach you? Right, so even if we look at rural areas today, defined as rural areas today, and we look at the ones that are doing well today, we've heard it, near a metro area and high amenities, right? Those rural areas tend to be doing better, right? And if you think about even this definition, right, if you're near a metro area, right, you tend to be doing better. And sometimes I think we just kind of stop. Yeah, you have to be near a metro area. Why? Why does that help you? Right, so there's a lot of reasons, but one, they have the jobs. Why not live in a metro area then? They have the jobs, why not live there? Because people don't want to. They're generally, we think, living where they want to live, right? So it starts to give you this clue of that there's rural areas that are doing really well on this idea of livability, on quality of life, that people want to live there. So this is a quote I pulled from The Economist, that when you look at mayors, so here they're really talking about a lot of mayors of very big towns, because a lot of this was based on data that worked for metro areas, where they have a lot more data, right? And it basically shows this trend where a lot of these big cities, mayors, are really transitioning from attracting businesses to ways to attract those people and really improving quality of life to promote their economic development. So when we think about quality of life, right, what does that mean, right? What does it mean to me? What does it mean to you? I could probably ask everyone in this room, and we might say something a little bit different of what we like or what we don't like. So we wanted to measure quality of life for every county across the US on the whole rural-urban spectrum, right? But not what I think is nice, what people there think is nice. How nice do they think it is to live there? And so we wanted to develop this metric using housing prices and wages to get this kind of location premium, where people pay a premium to live because they like living there, and use that to estimate quality of life, right? So if we have any, do we happen to have any real estate agents also in here? So I think we have mostly an ag crowd, but most of you probably dealt with a real estate agent at some point, right? But if you ask a real estate agent, what are their 3 favorite words? Location, 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 right? So this is really what we're trying to pull out of this data. What is the location premium people are willing to pay because they want just not any house, the house that's in that location, right? So if I had two identical houses, one's in Nantucket and one's in Enid, Ohio. So I'm gonna pick on Enid, Ohio a little bit. I lived there for 9 years. I loved it, but I know good and well my house in Enid, Ohio would not be the same price if it's in Nantucket, right? Because there's a different location premium there. So what we're trying to do is pull that location premium out of housing data, but also out of wage data. This is usually the one where people are like, what? So people are also willing to accept lower wages to live in a place they really want to live and work in. So I was working with another co-author, John Austin. He says, oh yeah, that's Traverse City. And I said, ooh, what do you mean? He says, oh yeah, so we like to say in Traverse City, you get half the pay for a view of the bay, right? Definitely, right? Why? People like to live there and they're willing to give up some of their wages to live there. So out of these two things, we're trying to get that premium, that location premium people are willing to pay just to be in that location. And so we did it for every county across the US. So here, the bluer are higher quality of life, the orange are lower quality of life. And we start to see some very regional trends, right? So we see bluish on the coast, right? Okay, probably people like beaches. We see some blues where the Rocky Mountains are, probably, right? People like mountains, right? We see some orange in Appalachia, right? It's probably struggling. This does not say they don't have natural amenities. So I have whitewater rafted in West Virginia. I've stayed in West Virginia. I think it's a gorgeous state, but it's struggling when it comes to these measures of quality of life, right? So when we start to think about what the quality of life is, so yeah, natural amenities are probably part of it, but they're definitely not the only picture. So we wanted to focus on small towns. So what we found is that using our measure of quality of life, places with higher quality of life had higher population growth, they had higher job growth, they also had lower poverty rates. These scatter plots, I told you I love some scatter plots, are looking at our measure of quality of life. Here I've pulled out just small towns or micropolitan areas, just small towns in the Midwest. And we can see those small towns with higher quality of life have higher population growth, which is on the left. On the right is higher job growth. We found it's especially true for small towns, and it's especially true for rural areas, right? So a lot of metro areas and a lot of the economists, a lot of different places have been talking about quality of life in big cities and what does that look like. We think it could be even more important in rural areas. And it was especially true in the Midwest. So I pulled out a couple data points here. So you see a lot of Wisconsin over there, right? A lot of Wisconsin counties are pulling it up, right? So if we go back to the little map here, we compare to Illinois. I don't know if anyone's from Illinois, right? Different story between these two states when it comes to their rural areas. When we're looking at Wisconsin versus Illinois, right? Very different, right? A lot of when we see that pulling up there, you can see, there's Traverse City up there. There's a lot of Wisconsin counties there, right? There's a lot of Wisconsin counties that registers pretty high quality of life. So we also have looked at this with small businesses. And higher quality of life is also associated with more small businesses and more entrepreneurship. Right? So then a big question now is, if I've convinced you at all, quality of life might be important, what makes a place higher quality of life, right? What makes it a nicer place to live? So what we did here is we threw, I should really count it, 200 some different amenities that we could measure at our model and basically let it run and pick out the ones that kept popping up as having the most significance, right? So one that popped up right away was recreation. So natural amenities mostly went away once we controlled for recreation. What does that mean? Yeah, it might matter if you don't have a beach, but not if you didn't do anything with it, right? So the natural amenities itself weren't the destiny. It was what you did with the natural amenities that you have, right? Whether that is skiing or whether that is kayaking or whether that is snowmobiling. It's what you did with the natural amenities you had. So one thing I've noticed, so I've peeked at a lot of the town's websites in Wisconsin because they pop up as super high on these, some of these indices. And one thing I notice over and over with a lot of these towns' websites of what they want to highlight is they highlight 4 seasons of something to do, all 4 seasons. That's not common in other states. What I hear in Ohio is, well, it snows here. What are we going to do? Sometimes it rains. That doesn't seem to be the issue in Wisconsin, right? As we heard today, when you have no snow, that can be an issue, right? Having 4 seasons of recreation is very different than saying, oh, we have this one season we kind of like and just ignore the other 3. It's a lot to ignore in a place, right? But it's really how you're building on what you have, right? Those assets. And those assets might be very different based on what you have, whether you have mountains or a river or a desert, right? You're building on whatever those assets are that you have. Arts and culture. So these are also, I should say, these are coming from some businesses. So those are businesses that say they do recreation, businesses that say they do arts and culture, right? So arts and culture can be very broad on what we think arts and culture is and very different in every community, right? So some people hear arts and culture and they might think an art gallery, right? In Vermont, that is very much what they think. Lots of cute little art galleries in those towns, right? Arts and culture could be even a park. So this is actually a small town, Lawrenceburg, Kentucky. They love to pull out, so they put a splash pad in there. And the splash pad has a bourbon barrel that just sprays water on the kids. All right, I don't know if it's appropriate or not, but I kind of like it. It's kind of cute, right? Because it's really building on the kind of culture that they've built in the region, right, of their bourbon trails, right? We like living here because of all of these things, and we're going to kind of do a nod to that with this bourbon barrel spraying water on the kids, right? So is that recreation? Is it culture? Right? Is it something for kids? Is it parks? Right? There's so much that kind of goes into that. Data can only get us so far, but it starts to give us clues of what can help. Better health matters, right? We heard a lot from Marie. She did a fantastic job, right? Healthcare matters, right? Having a place where you have access to healthcare, where you have these healthy outcomes is associated with higher quality of life. Food stores, right? Relatedly, having a grocery store helps. So I talked to someone in Boston, like, man, everyone talks about food stores. I just don't know that it matters that much. I said, that's because you have it, right? When you really have something in abundance, you're like, I don't know if it matters. Once you don't have it, that's when you realize, okay, no, that kind of did matter, right? Food stores always shows up. It's important to have access to that grocery store. Personal care places, right? Some place to cut our hair, or for the guys, whatever the guys do, I don't know. Proximity to a metro, right? Being near a metro helps. Good schools. Here we're measuring good schools by how well they're funded. How much money are you throwing at those good schools? Which can be an issue in a lot of rural areas, right? It matters, right? It's one thing, so I've got 3 kids, right? It's one thing parents pay attention to. What are the schools like? Also, we looked at what are the percentage of people that work from home. Here we think part of that story is broadband. Can you work from home? Do you have access to broadband in this place? And so it starts to give us clues that we think can generally help build that quality of life, and probably, as Saya mentioned, in a way that's tailored to your community, right? What do each of these mean to you? Thinking about your assets, thinking about your strengths, and also your weaknesses. What specifically does each community need to focus on to build up that quality of life, right? So I mentioned helps for population growth, job growth, but also businesses, right? Even when you just ask entrepreneurs, how do you pick the place you picked, right? Well, it offered a high quality of life. And that's what the people I want to hire are also looking for. Some entrepreneurs recently I've been talking to said that's where I'm from, right? They wanted to go back. Some were in DC and moved back to Mississippi because that's where they were from. Some were in LA and moved back to Mississippi because that's where their spouse was from. That's where they wanted to be. They had that connection, those roots that were part of the quality of life that they wanted to be a part of, right? That mattered. So we think this model helps also towards, rather than this kind of vicious circle of decline, it can help move us towards a more virtuous circle, right? Where we're focusing on a more holistic approach to community economic development, where we're improving quality of life, that we think is providing communities with a good foundation to start businesses. And those businesses that are started locally, small businesses, can have a bigger impact when they're more connected to their community, right? And a lot of those small businesses are also providing the things that people want and need in their community, whether it's that grocery store or that personal care service or that we heard today from the cool barn restaurant thing that Beth talked about, right? They're all improving that quality of life, which then further attracts more businesses. But a lot of that, as we've heard, right, it also requires other stuff, right? So this quality of life is a good foundation, but you also need more investments, right? Broadband. It's hard to start a business if you don't have access to broadband, right? It's hard to continue your business if you don't have the workforce trained in that business, right? So quality of life, we think, is an important element, a foundational element for community economic development. But I don't know if this is the bad news. I shouldn't end on bad news, but it probably never stops. So we've started to look at quality of life over time, and one thing that's been kind of surprising are the communities that kind of maintain their ranking in quality of life have continued to invest. They have that new splash pad. They have new downtown initiatives, and that's just maintaining their ranking. So it was kind of surprising to see that just to maintain your quality of life ranking, you have to be continually investing in that community. And so it doesn't stop. And even once you have that great foundational element, you need infrastructure, right? You need broadband and other things to help that virtuous circle continue to move. All right, that is it. Thank you. I think we're on to the conversation part now.
Amanda, did you pick those pictures? Did you know how many pictures were Wisconsin on your, did you see the Madison picture?
I think I was supposed to come here to like help inform you guys, but really Wisconsin has more helped informed me, so I'm all ears.
Yeah, it's pretty cool. I liked some of your comments, and like you said, just the fact that we match up on something. Good. All right, questions? Time for both of you. I get what you're saying about once you hit it, you got to keep going. It's like a house. You got to keep investing. You got to keep going. Any idea on the time to accomplish from one step to the next? I'm not saying from beginning to end because theoretically the end is never, you know what I mean? But give us a sense of time. I think that's the real, from everybody that spoke today, you were all fantastic. But the one item that nobody really spoke to completely is time. Trying to find leaders in a rural community that have the time. Trying to find people that can dedicate to analyzing that aren't necessarily full-time paid staff. The time. The parents and school. The time. So can you give us a little sense on the time commitment that you kind of found in your research, other people's findings? Because I think that's something everybody would like to get a little bit better handle on. If I'm not doing it right, when do I know I got to find somebody else to help me? Or, you know, nobody's out there really telling us that.
Yeah, so real quickly, I'll just speak with my, from just personal accounts, is one that we know that our communities that may be experiencing a lot of challenges, they didn't get that way overnight. So they're not going to be able to move the needle overnight as well. So it does take a little bit of time with that. And then on the other side, around like volunteering and finding community leaders to stick with it and be involved, I just thinking of my own sort of personal circumstances. I may not have the time to stick with a 3-month process or go to a 3-month training or technical service. But what I can do is you can be able to tell me like a start time, an end date, a start date and an end date. And then whenever I have time, I can incorporate that into the work that I am doing. And so being able to understand who you're being able to ask at the table, so being able to have that understanding and knowing who you're asking to volunteer and understanding how they would want to being able to be involved in that process. I think on a personal level, being involved in my own community has been something that I found to be successful.
Yeah, I think what we would really like me to say right now is you just do this one thing and next year you'll be fine. Unfortunately, it just doesn't work like that, right? It has to be lots of things that you do year after year. A lot of the communities that are doing really well have been working really hard, some for decades and decades. in decades, which is like the worst news I could probably tell. But I think that means is we also need to do a better job celebrating small wins, right? So it's really easy to celebrate a big ribbon cutting, right? That look how big that bow is. But the size of the bow does not determine the size of the economic impact, right? So we need to celebrate that small business. We need to celebrate if it's, a small housing development. We need to celebrate a small part of maybe downtown. Like those small wins that we do over time, we need to find ways to celebrate in big ways because we need the encouragement to know that what we're looking for is kind of very steady, very unsexy growth, right? Not amazing stuff. And to kind of celebrate what looks not that fantastic in the data sometimes.
Yeah. John?
Yeah, I have a question here. So just from listening to Matt and Amanda, your guys' talk, it really hit me that amenity-rich areas or having amenities that you can use is really big to rural livability. In Wisconsin, if you look at our license plates, it's pretty clear. We have two big things that are big in rural areas. We have a ton of water resources, and you see our sailboats on our license plate, and you also see the dairy farm. And so one of the things, and this kind of gets to a point, Samantha, you brought up around the community facilitation. And one thing I don't know if we've talked about is that, and this is unique to rural landscape change in the Midwest, where we have a lot of competing land uses. But in Wisconsin, we've been on a trajectory agriculture-wise where we're starting to deal with issues of mass imbalance, which creates a lot of non-point source pollution, which creates threats to our water systems. But changes are also to agriculture are viewed as threats to agriculture. And so there's these competing narratives. And I'm just curious if that's something you guys have seen in other rural areas and how you recommend handling those competing narratives. And are there ways where you build symbiotic relationships? Because right now, we actually one of the threats I see in our rural areas is that we have an immense agricultural opportunity, but we also have immense opportunities when it comes to our recreation. And I think there's ways for those to be compatible, but frankly, at this juncture, they're not. So I just wanted you guys to grapple with that.
Well, yeah, I think the short answer is carefully. I can tell you, all focus on Ohio. On average, if you have natural amenities, you get higher growth. In Ohio, you get lower growth. Ohio's different. What are we doing differently? Well, we advertise Lake Erie as a place for businesses to come and use the water and dump in, right? I've heard a policymaker say this. I was like, ooh, you can't advertise having a great lake, but also go to businesses and tell them to go dump in it, right? Those are competing interests, right? How do we do this in a way? And I think we also need to realize that ag is a business, right? Their families need to survive. It's a business, and they're going to make business decisions, right? This is, and again, this is me as an economist hat, right? We should expect people in general to work towards, their interests and for their business, right? If you do have those competing interests, right, then that's a place to step in and say, what can we do from a policy perspective it could be subsidize a different way of doing that ag, or to map out specifically where that runoff is, right? So in Ohio, we get very large algae blooms occasionally in Toledo, but it's not just from ag, right? Yes, ag is part of it. And so understanding what all of that runoff is from and what we can actually do in that runoff for that very specific place. And there are places where the runoff matters, and there are places where the runoff matters less, right? So having a better idea of where it matters more and where it matters less, and where we can work with farmers to make it in their interest to potentially, pay attention to where that runoff matters more, right? I think that has to be also making it, whether that's government or the community come together and making it in, the farmer's interest to pay attention to that runoff and what's a solution that might work.
Yeah, I think this is a place where, like you had mentioned, like the community facilitation is going to be your strongest suit as well in that conversation. And being able to have an organization, it sounds like you already have some amazing folks, Beth, as one who's convening, who has that convening power that may not have those competing interests, but being able to be, doesn't have to have any of that competing interests to kind of set fire maybe to some of those challenges that may be there, but being able to bring all folks to the table to being able to do some of that community facilitation. So being able to rely upon resources such as that, that are maybe be inside your community or outside of your community that your state offers, I think is definitely a really good start to kind of being able to kind of really think back to not just what Amanda was sharing, but then also kind of having and being able to rely on those resources for community facilitation.
Don't go it alone. Pete?
Today we talked a lot about agriculture, and a lot of states identify by the culture of their people. And in Wisconsin, we talk about how people are hardy, and like how milk first defined our state, you know, the dairy state. Have you gotten any measures of people talking about the character of how they grew up or who they grow up, like their parents and grandparents? Is that a meaningful thing that they're looking for? And then as a challenge in our modern world that we want the latest iPhone, what is the dichotomy of quality life? Does it involve any of the human characteristics of wanting to feel some of that comfort of where we're from?
Yeah, so actually, Andrew Van Leuven and I can't remember his co-authors on this paper, but they just looked at social capital and how important social capital is, and found that social capital is even more important for rural areas. And it's even more important for rural areas that have large minority communities, right? So that connection to each other, and it's kind of one of the things that data, doesn't probably measure as good as other places, that we know that social capital, it does matter, and it matters more for rural areas. So one thing that I've also heard from a rural resident in Illinois is, I can't get my kids to come back because I don't have broadband, right? They just won't visit because they're like, oh, there's no broadband here, and they want to be on their phones all the time. And for him, the broadband was very much a quality of life thing, and it was the key to his kids even coming back and visiting him. And it was part of, his connection to his kids, is thinking about, how that broadband made it a nicer place to be and nicer place to visit, as much as it is also important for businesses. But I think social capital is real. I mean, I'm a parent, right? So I'm trying to give my kids roots and wings, right? And I think that social capital is part of those roots that we give our kids, and I think it's important for a community.
Okay. Yep.
Hi, yeah, you guys hit briefly on this, but perhaps you have more to say. Oftentimes when we think about rural development, we also hit on the topic of community wealth building. And when we look historically, part of the reason that the Midwest has somewhat more equitable rural outcomes is because we have this history of more egalitarian communities where land ownership and home ownership is pretty widespread. But we're also seeing trends of declining home ownership and disinvestment in some rural areas. What have you seen as promising practices for community wealth building in rural areas?
I think what you said is, we have to think about what data can show us generally works, but also what works for that community, right? And I think it's the conversation. So I've also been to communities where, so I'll pick on near where I live, Akron, where a policymaker in Akron says, well, how do we be Pittsburgh? But you're not Pittsburgh. The best you can ever be is a second-rate Pittsburgh, and that's if you do that really well, right? You want to be a #1 Akron, right? And I think that's also something that we need to talk about, and it's about a conversation with those community members is, right, how do we work together to figure out who we really are? And for a lot of communities, so especially in Ohio and all over a lot of the Midwest, is a lot of communities, once that plant came in, Ball Corporation or whoever that was, they started to build their identity around that plant. And so a lot of communities are coming back to a conversation of who are we, right? Are we just Ball Corporation that makes glass jars, or is our community something more? And thinking about what has it historically been that they can build on to think about that. And I think about doing it in an inclusive way where involving a lot of what Sam said of how we're having those community conversations of what are our strengths, what are our weaknesses, how do we build on that? But I think it also means you have to reach out to people. So a lot of times, some mayors and city council people will rely on who comes to those meetings, who comes to the table, and who comes to that conversation. And the problem is it's not a representative sample, right? Doesn't mean you should ignore them. I'm not saying that to any politician, right? Don't ignore anyone. However, we need to realize it's not a representative sample, and there are many people who aren't there who care very much about their community. So it very much also means finding people where they are at, which might be different in every community of where they are at, right? Are they at drop-off for school? Are they at the grocery store, right? Finding people where they're at to figure out what they view as what are their struggles, what are their community strengths, and how you can build on that for broader community economic development.
Yeah, and I just add to some resources that we have available that we have the Richmond Fed who's working with Invest Appalachia and Appalachia communities, really working on and understanding around rural development hubs and kind of creating and working in that space. And then the next is, I'm just thinking about my own set of circumstances whenever I was returning back to my community and I was looking and thinking about where to move, where to live. And my grandfather was like, well, we've got plenty of land, look to your left and look to your right. Wherever you want to build, you can. And I said, well, all of this is heirs property, right? Like, no, the family and getting a part of that, it's a little bit, at that time was a little bit difficult. And so we have the Atlanta Fed that's doing some really critical research and conversations around wealth building around this land property. So when we're thinking about specific examples, I know that's something in the South that we deal with and are having conversations with. And I think that this is where, us in the Fed space can really play an important role to be community researchers and areas of looking at and working with communities around this conversation around wealth, because a lot of times we have the ears of understanding and working with these financial institutions and other players in that space.
I think we also need to be willing to take risks and do new things. So as much as we see like recreation has worked in a lot of areas, a lot of the recreation jobs don't pay that well. So you're not offering opportunities for a lot of people to rise up and to have something higher paying. It might be a great place to start, but if that's it, it can be hard to live off of the salaries of a lot of recreation jobs, right? Which is why we need to start thinking about what are some of the highest paying jobs out there. So when we look at tech jobs, they're the highest paying jobs out there. And we're seeing a lot of communities, a lot of rural communities with a lot of very innovative new tech jobs. And some of them are only ideas that I think could have come from those communities because of their culture, because of their social capital, because of all of the assets they have, I think is why that idea came from that rural community. So one innovator we just heard from is a local football coach, is important, as a local football team is in the area, and he wanted a headset. And he was looking for, I just want to buy a headset like that you see on TV for the football players. And he looked at how expensive they were. I literally could not even guess what he said. They're like $500,000, right? And he's like, whoa, that's beyond my salary as a high school football coach, right? I can't afford that. He's like, there's got to be something better. And he came up with it. So he's working on a Bluetooth headset that is way cheaper than anything he could buy in the market, right? Because that is what he needed for his job, for his town, where football was really important.
Yeah, and I think going back to, that's the main reason why we kind of had this book, is really thinking about the conversation around shared economic prosperity. And it's so good to see that you all have a state office that's dedicated to that, and really looking at the assets, from an assets point of view, and really thinking about just, the conversation. I thought it was great, Matt, when you were talking about you have these competing football towns maybe be right beside each other, but we can't afford to be competitive when it comes to regional economic development. And so looking at regional cooperation and how we because we're coming from the same labor market a lot of times. And so what does that look like? How do we kind of create this sort of shared economic prosperity where all can thrive, I think is a conversation.
Yeah, only on the gridiron. And appropriately enough, the last question from our dude that sent us on this merry little trip today, Paul.
I've got a question. Both of you had this in your slide set. Samantha, I think I took a picture of it. Your point number 3 from your 5 keys is about the importance of leadership, and same with yours, your little big picture up there, Amanda, had leadership, right, by broadband leadership and something else. both of you, we haven't, like, where does leadership come from in your experience, what you've seen? How do you facilitate, why is it so important, and how do you make it better? Or does it grow and homegrown? Does it come from elsewhere? How does that emerge? How do you foster that? How do you keep that going?
Oh, that is a great question. I think, so I'm also an Air Force Academy grad. So we learned a lot about leadership in my program and thinking about leadership and how we can build that leadership up. So I think we've moved from this thinking that something's innate in us, like you just have to be born a leader or born good at math or born good at whatever, to really knowing now that it's built. It takes practice, right? And I think the same is true with leadership. And I think really it just takes a spark, and to me that is a passion or a love for something, right? A love for that community and wanting to see it do better. And a lot of what we are seeing in a lot of communities that have this kind of leadership capacity is it starts with a spark, a love, right? To want something better for our community, to want to see our community succeed and do well. And then from there, sometimes it's trying and failing and taking input and, taking that spark and building it from there in a community and figuring out who are kind of the stakeholders and who do I need to reach out to in that community to start to build momentum. And so I think it really just takes a spark, a lot of times a love for that community, and then, reaching out for insight. And this is really what we try to do, with research, and whether it's, the Fed or where I work, of what insight can I provide for that leader, right? Because they don't have economist on staff, right? So what can I provide for that rural leader that can help them? All right, here's my spark. Now here's something I can try. Here's something that worked in this community that might work in my community. Here's where I can adapt it. And so this is where I think it becomes especially important for rural communities to have that good data-driven research of here's something that we can try that will work for our community.
I've had the great pleasure of reading the 600-page book of what we have together. And it comes up time and time again around leadership. How do you foster it? How do you grow it? What's needed? Whenever when we were talking with folks, they were saying, well, it takes really good leaders that are in those communities and rely upon them. And so it comes up time and time again. And I really love, there was about 2 or 3 examples where they actually, have these sort of leadership or, I heard that there's even kind of one within the cooperative where you have a leadership development program. And it's just so key to being able to both where you're not just trying to have these leaders together, but you're learning, right? That those folks, whenever you're bringing them together, they're actually teaching us something more about what it is that can happen and what's possible. And so I think that, it just comes up time and time again, and so many great examples about how to foster leadership. And I think that whenever you're looking at rural development, what's key, that's definitely good. So happy to see that you all have those programs available.
Well, the conversation doesn't have to end now. The reception will begin, but the conversations do not have to end, and I will not silence you from this point on. Want to make sure that we give a warm thank you to Dr. Paul Mitchell, Jeremy, Lucas, our AV man, and the staff that have helped us to enjoy this facility today. I don't know how you're going to trump this one next year, dude, but if you come up weak with the program, don't ask me to MC it. So thank you again to all the folks that helped to corral this. And thank you to our marvelous speakers coming from far and wide to winter, Wisconsin. We so appreciate your insights. And just, I think for a lot of us that are country kids that love our communities, some of the insights that you've given us help us remind ourselves about that passion. So that's very good. We appreciate it. But like I said, conversations don't have to end, but the official program has. Thank you very much for coming, everybody. We'll see you next year.